markets, headlines, and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
And it is 10:21 on Wall Street. We do check the markets all day long for you here at Bloomberg. And U.S. inflation, well, it cooled sharply last month, and that is offering fresh hope that the Federal Reserve can soon wrap up the most aggressive interest rate hike in decades. The Consumer Price Index rising 3% last month from a year ago. According to data out today from the Bureau of Labor Statistics, from May it advanced 0.2%, but pouring cold water on the hopes that the Fed would ease up on the rate hikes. Michael Gapin, head of U.S. economics at B of A Securities, says he needs to see more before the Fed can lay off the rate hikes.
For me, it's about broad-based disinflation across services. Yes, we should get some payback in goods prices. We saw that again this month with used cars. But can we get a combination of disinflation in services? So beyond shelter, I agree with you. I'm not sure airline fares fell 8% on the month, but is it broad-based enough to make you confident that the new trend, or we're back to our prior trend of roughly 2%?
Yeah, we've been talking a lot about those airfares falling 8% on the month, but we'll see. I mean, that might not hold up for the rest of the summer. Certainly, I have not experienced that. Gapin there on the Bloomberg Surveillance podcast. And checking on stocks right now, we do see broad-based gains. The Dow up 277 points. The S&P 500 up 46, and the NASDAQ, it is up 196 points right now. The yield on the 10-year Treasury, let's call it 3.9% right now. Crude oil also gaining. It is higher at the moment, as is spot gold, also higher. United Auto Workers opening contract negotiations with GM, Ford, and Stellantis in the coming days. And this new worker contracts, it could cost the automakers a lot of money. We're checking on the stocks of Ford as well and shares of GM. The new worker contracts and a prolonged strike, it could cost automakers billions of dollars. And that is a Bloomberg Business Flash.
All right, Denise Pellegrini, thank you so much. We appreciate that. Madison Mills, Paul Sweeney here in the Bloomberg Interactive Broker Studio. Good day in the U.S. markets. S&P up 1%. Think about European markets. The FTSE this year up about 8%. I'm sorry, the FTSE's flat. The stocks index, the European index, stock 600, is up about 8%. So lagging, but they outperformed last year. But let's get an overview of what's happening in the European markets. We can do that because we got that kind of person here. Tim Craighead, Director of Research for Bloomberg Intelligence, and he's a senior European strategist. He's based in London. We got him here in New York this week. A couple of you guys are here in New York this week. I mean, everybody's traveling. All right, so Tim, thanks for coming in here today. Give us an overview of kind of year-to-date, how are the markets in Europe, and kind of what's the outlook?
So there's been a tug-of-war going on in Europe between earnings and valuation, depending on the mood of the market as it relates to what's going on with inflation and interest rates. So it is not dissimilar here from the standpoint of some of the drivers, with one big exception we can get to, tech. But in Europe, essentially we've had, as you said, a pretty decent market. And you talked about the Euro stocks being up 8%, or I should say the stock 600. That's the broader market. That includes a big chunk of the UK, which, as you said, was flat. If you take out that, you look at, say, the Euro stocks 50, which would be sort of the Dow Jones equivalent. Okay. That's now up 14%. I mean, it's been a decent year. The key has been positive earnings revisions that started as we got into 1Q earnings, offsetting and overwhelming valuation contraction that's occurred with the idea that interest rates are going to be elevated for longer because inflation is still very sticky in Europe, in particular services and wages. Yep. So I just threw a lot of stuff at you, but markets are behaving. Key now, as we look into second quarter earnings that are getting ready to hit the tape, is can margins really maintain where they are, which are at record levels? They've been very sticky in Europe, unlike here, where they had rolled over.
Right.
So it's a very, very interesting dynamic as we go into mid-year earnings.
So things are good, but it's still relatively cheap when it comes to an American investor to get in on the UK, right? So is it an argument of the UK is so cheap that you have to own it at this point?
Quick answer on that is absolutely no.
Yeah, tell me why. Tell me why.
And you could look at that more broadly within Europe. I mean, our work in terms of global equity strategy within Bloomberg Intelligence leans towards emerging markets, then Europe, then U.S. So, we do like Europe in concept. And within Europe itself, the market overall is trading at about 13 times forward earnings. Clearly that's very low relative to the U.S. where you're at 18.5, 19 times. Take out tech. If you look at the equal weighted S&P, several multiple points lower. So it's not such a stark contrast. And Europe just doesn't have technology. We don't have the internet element. We do have some semiconductors, but we don't have the rest of it. And that's a big difference. So you can't just say it's cheap, you should buy it. It's cheap because of composition. And the UK specifically, not to over-egg this, but big on some big consumer staples, but a chunk of that's tobacco. Tobacco trades at a lower multiple. It's big on financials, but a chunk of that is commercial banks, which trade on lower multiples. And it's big on energy and materials. And given that we're still close to cyclical peak commodity earnings, they're trading at low multiples. So it's not cheap in a comparable basis. It's cheap because of composition.
China. It feels like to me, when I think about some of these European companies, as Siemens, just for example, but some of the big manufacturing companies in Europe, they depend more, or they do more business with China. What does the China reopening mean? What does the China, a little bit of a Cold War building between China and the West? What does that? What are the companies in Europe saying about China as a supply chain issue and as obviously an end market?
I think China is a more relevant opportunity for the average European company than it is for the average U.S. company. The U.S. market itself has a lot more of a domestic focus than the European market, which has both U.S. and Asia. If you look out on a revenue exposure basis, Europe is more globalized. And from that perspective, part of the hope early this year, January was a good month specifically for the European markets, as was December, was the China reopening trade.
Right.
And the issue with that has been, as of late, which I'm sure you're aware, the more recent statistics have faltered, and it seems like that's sputtering. That's not great for the second half outlook, all else being equal for the European markets. Our China strategist is still relatively sanguine that more stimulus is coming, more policy measures will come, and there are opportunities. And as Ed said, the emerging markets are an area, all else being equal, that we do find intriguing. But China's a big deal.
Yeah, well, of course. And hopefully this earnings season, we're going to get a little bit more of an indication as to how the strength of the Chinese consumer is going to potentially impact some of these profit margins. Having said that, we are seeing that the dollar is hitting near 15-month lows now. How does that play into your calculation?
This is another one of those elements for the second half outlook in Europe. And by the way, if I were to use a word, technical as it is, it would be sloppy. That's kind of what we see.
I'm going to steal that from you when I'm trying to sound really smart on there.
Exactly. Currency is a big deal. If you look at the third quarter specifically, by the time we get into that as a reporting period in a few months, whether you're British, whether you're Euro-based, or whether you're Swiss franc-based, currency is going to be somewhere between a 10 and 14% headwind for you on a year-over-year basis.
Wow.
It's a huge hit.
Yeah.
And some companies will hedge that away. Some companies are producing in the local market, and so there's different accounting opportunities to minimize the impact. But just overtly, if I'm a Swedish company and I generate 100%, the Swedish industrials are a big deal. I generate all of my sales abroad. It'll be an interesting element from the standpoint of currency impact.
But maybe a tailwind for some of the consumer staples that you mentioned?
Well, but again, if I'm Unilever, if I'm Diageo, I'm based in what is a strong currency.
Right.
And so, it may be, it's more a combination of what's going on from the local economic, the local consumer spending perspective for those consumer-based companies. But the issue with the defensives, in ways they've got more currency exposure for a euro of revenue because they don't have a cyclical element to offset. It makes it more dependent on the currency being a swing factor. So if you look at a correlation analysis of who has the most negative correlation with currency, it's healthcare and it's staples.
Real quick, 20 seconds. A pint in Belsize,
Favorite question,
Belsize Park. It's a suburb of London. What's that going to run me today?
7 pounds.
Really?
Yeah,
That's inflation.
But that's a big beer.
That is a big deal.
That's
inflation.
That said, dude, I had breakfast this morning.
Yep.
You're talking ridiculous. My wife is over here, had a pizza yesterday for lunch.
Yep.
26 pounds for a pizza that was the size of a plate.
Over here it's terrible.
$26.
All right, Tim, thanks so much for that. Tim Craighead, Director of Research, Senior European Strategist, Bloomberg Intelligence. Right now, let's head down to Washington, D.C., World and National News with Nathan Baker.
Making me thirsty. Thank you. Ukraine's future lies in NATO. That is what we are hearing now from President Biden at the NATO Leaders Summit in Lithuania.
Allies all agreed to lift the requirements for membership action plan for Ukraine and to create a path to NATO membership while Ukraine continues to make progress on necessary reforms.
President Biden spoke there after meeting with fellow Group of 7 leaders on a set of new security guarantees for Ukraine. Bloomberg's Anne-Marie Horton has more on how Ukraine's president is taking it all.
Zelensky having this reconciliation, if you will, compared to his scolding yesterday on Twitter when it comes to the West. He's saying that, of course, we know that some are anxious and worried that Ukraine at this moment could be a part of NATO, given there's a war there. He said for the first time today, he does feel like he has given that recognition that one day it would happen.
Bloomberg's Anne-Marie Horton at the NATO summit, where President Biden will be giving a speech at 12:45 Wall Street time. It's a little more than 2 hours from now. You'll be able to hear that live right here on Bloomberg Radio. Another restrictive abortion bill is moving ahead in the heartland. Republicans in Iowa passed a measure late last night that would mostly ban the procedure after about 6 weeks of pregnancy. This happened during a one-day session called by Republican Governor Kim Reynolds on just this one issue of abortion. The governor says she looks forward to signing that bill on Friday. This year's Emmy nominations are going to be announced this morning, but they are coming under the threat of another Hollywood strike. The actors' union contract with the studios and the streaming services expires late this evening. If a strike does happen, the actors would join Hollywood screenwriters on the picket lines for the first time together since the 1960s. Global news 24 hours a day, powered by more than 2,700 journalists and analysts in over 120 countries. This is Bloomberg.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
And it is 10:40 on Wall Street. We check the markets for you all day long here at Bloomberg, and we do have some celebrating when it comes to stocks today, and that's on that sign that we've been talking about, that inflation is easing at least a bit. Inflation for June coming in weaker than expected. Ira Jersey, chief U.S. rate strategist for Bloomberg Intelligence, calls it a good sign if you're hoping the Fed will stop the hike soon.
You know, with this kind of data where, you know, the Fed has to be pretty happy actually about what they're seeing. So even though they're probably still kind of committed to hike in July, the question is, will they hike then again in September, November? And I think that that's very much in doubt at this point when you get really a low core print. So when you look at the core print, it was actually under 0.2%. It only rounded up to 0.2%. So it's actually a pretty decent print overall.
Yeah, and Jersey there on the Bloomberg Surveillance podcast commenting after we got those headlines here on the Bloomberg terminal saying the Consumer Price Index raw rose 0.3% last month from a year ago. The Dow, it is surging up 283 points right now. The S&P 500 is up 48, and the NASDAQ, it is up 199 points. Now, including prices on food and rent not going up as fast as they were, and prices on airfares actually going down in that June report, we are seeing a lot of signs that inflation at least is easing a bit. Energy, though, we are seeing crude oil this morning. Brent crude, by the way, rose above $80 a barrel for the first time since May, and crude oil in the U.S. also rising. And the yield on the 10-year Treasury right now, it is about 3.9%. Spot gold, it is rising up about 24 points right now. And on the housing market, another report showing home prices hit new highs in June. Zillow says a typical U.S. home value crossing above $350,000 for the first time. And the number of homes coming on the market is closer to a normal October, i.e. slow, not the usual fast-paced June. So there are more signs that inventory is constrained. And that is a Bloomberg Business Flash.
Denise Pellegrini, thank you so much. We appreciate that. Looking at the yield space here, big move in the two-year Treasury down 14 basis points, 4.73%. That kind of gets your attention here. And looking at the Bloomberg Index browser, INGO on the terminal, the Bloomberg aggregate total return, unhedged return here for the bond market, up 1.3% year to date. So that's a lot better than last year. Let's do some more work on the investment grade business out there in the fixed income space. Natalie Trevithick joins us, head of investment grade credit strategy at Payden & Regal. Natalie, thanks so much for joining us here. What's your takeaway from this inflation print that we saw this morning?
Well, it was a very good print, but being a bond person, I always have to look for the bear scenario. And I'm like, maybe it was too good. Why couldn't we just get that 0.3% month over month on core that we were hoping for? Because now you see the stock market's up again. We got really good news in terms of airfares and hotels moderating. But maybe it makes corporate America think that, hey, we can go about raising prices again. And because the economy is doing so well, we still have that strong wage growth and the employment picture is still very strong. So it seems like the economy is firing on all cylinders. Are we in this Goldilocks scenario and avoid the recession altogether?
Okay, so you think that the CPI print from today could lead to price increases because why not? The economy's cooling a little bit, so let's just try it out?
Yeah, like maybe not right away, but it also shows that there's still strong underlying growth in the economy from the employment picture, the spending that we're seeing in services. It was great to see that moderation in goods, and that's definitely come down. But there's parts of the economy which are still running a little bit hot. So maybe companies don't have to do the layoffs they were possibly thinking they had to do earlier in the year. And it is a very nice scenario. So, but it doesn't mean the Fed's probably going to have to cut anytime soon, even if the second rate hike for this year is maybe more in doubt at this time.
So, Natalie, have you and the good folks at Payden & Regal, have you taken the recession risk off the table here?
not off the table, but we've definitely pushed it out further down the road. So it's not a time to be cautious. Yields, even though they've come off the peaks from last week, they're still pretty high. So as you were saying, the ag returned 1.3% year to date. IG Corps are above 2%, but high yield bonds have returned 5% year to date. So we still think it's a nice coupon clipping year for credit. And so you can still expect some good returns in the second half of the year. And we don't want to be too defensive and lose out on those.
And what about corporate spreads in particular, looking a little bit tighter in the month of June? What do you anticipate that looking like in the second half of the year?
Yeah, they really rallied after the debt ceiling resolution, and they're continuing to do pretty well in July. So they're through the tights of where they started the year at the beginning of the year, despite the banking crisis. So we think they're maybe a little bit on the hot side right now, but we don't really see a case for them to blow out if the recession is pushed out to, say, late 2024 or 2025. So we think you have to definitely pick your spots now. We saw a little bit of a beta rally in June, and maybe that went too far, but there's a lot of good names out there which we think can perform well, but we wouldn't expect too much further spread tightening from here. So the bulk of your return is going to come from that carry and coupon clipping.
Natalie, how's the credit quality out there in the market as you look across your portfolio? We've heard people saying, boy, it's pretty darn good. We don't really have any big issues here at the moment.
We really don't, because companies that are on the cusp maybe of low BBB going to high yield have already taken steps to either reduce CapEx or cut dividends. So they're really focused on maintaining their IG ratings. And if anything, we're seeing more upgrades, particularly out of the energy space. So if anything, we're expecting more rising stars than fallen angels in the coming year.
And when you look at the second half of the year, too, I'm curious if you think that we're maybe underpricing the idea that the market will always give us the most painful possible scenario. Do you think that there's a potential outcome here of, big tech dropping and volatility going to the upside in the second half of the year?
I think there's potential. I feel like we're going to cruise through the summer, but there's definitely potential in the second half of the year. It seems like tech is, really celebrating this the CPI print today, but it does seem like it may have gotten a little bit ahead of itself. But still, the magic words AI just propels it forward.
All right, Natalie, given where we are here in this cycle, given where we are with kind of, I think most people feel like where the Fed's going to go over the next meeting or two, if not the next 6 months, what are some of the sectors that you guys are finding attractive right now?
Yeah, we like some of the defensive sectors like consumer, non-cyclical, and utilities because we think they're well positioned to do well if we do get that volatility. We've become a little bit more cautious on the banking sector, even though we think we're out of the crisis. We think banks have a lot of funding to do, especially if there's increased regulation and capital requirements. So just a little bit more cautious there from more of a relative value perspective. And then it really comes down to individual name selection where we think, we rely on our credit analyst team to find value there.
And longer dated bonds, would you say that they're becoming more attractive given some of the potential Fed moves we're anticipating?
Yeah, they've kind of been the sweet spot all year. 10 and 30-year demand in the new issue market is always the strongest. And at these higher all-in yields, closer to 6% or above 6% in some names, it's attracting a lot of buyer interest, even though you can get higher yields in the front end of the curve. But people want to lock in these rates for longer.
All right, Natalie, I can tell from your accent that you're Canadian. And I see you went to Queen's University, so I have to ask, how did you find yourself all the way down in Austin, Texas for your MBA?
Yeah, Austin, I just wanted to go somewhere hot, and it was in 2000 during the energy boom, so I thought I was going to go work for Enron, and I interviewed with them. But fortunately, I made the right decision and ended up at Barclays Capital on Wall Street, and from there down to PIMCO, and now at Payden.
Yeah, exactly. So you dodged a bullet there with Enron.
Yeah, definitely.
Yeah, I bet you Texas sent a lot of kids to Enron back in the day. The trading desk.
Oh, they sure did.
Yeah. All right, Natalie, thanks so much for joining us there. Natalie Trevethick, head of investment grade credit strategy at Payden & Riedel, talking to us about what's happening in the credit space. Again, we're seeing yields come in on the back of that tamer than expected inflation print. The 10-year Treasury's off 8/32 to 3.88%, but seeing some real movement in the short end of the curve. The 2-year Treasury pulling back in 13 basis points to 4.73%. So a little bit less inverted yield curve there. So some movement in the bond market, Madam.
Yeah, and it looks like a lot of green across the screen when you look at the S&P, the Dow, and the NASDAQ. The only red I'm seeing within the S&P is within the healthcare space, a little bit of red there, and also a little bit of red for Papa John's today after one of their competitors made that partnership with
Yeah, and
Uber.
that's a big thing for Domino's Pizza, and it's a big move higher in the stock. And I was talking to Mike Kalin, he covers all the restaurants for Bloomberg Intelligence, and he said, yeah, it is a big deal for Domino's, and we're seeing that certainly in the stock. We'll have more coming up. This is Bloomberg. All right, let's get some company news right now. Steve Rappaport.
Paul, a Federal Trade Commission is mulling options after a judge rejected the agency's bid to block Microsoft's $69 billion merger with Activision Blizzard. Bloomberg's Doug Krisner reports.
We're told the FTC is leaning toward filing an appeal as soon as today. A federal judge found the FTC did not prove the deal would harm competition for gaming. But Robert Landy of the University of Baltimore Law School said the law only requires the agency to show a deal may substantially lessen competition, not that it will or is likely to. The judge extended an order blocking Microsoft from closing the deal until midnight Pacific time on Friday. The FTC would need to seek an emergency stay to extend. The question is whether the appeals court would rule before the deal's deadline on July 18th.
Thanks, Doug. Microsoft stock is up this hour more than 2%, Activision down more than 1%. U.S. mortgage rates climbed last week to their highest rate since November, the contract rate on a 30-year fixed mortgage topping 7%. And inflation is poised to take a toll on another market, back-to-school supplies. Bloomberg's Kimberly Adams has more.
According to market research firm Deloitte, parents are expected to trim spending by 10% for each child this year. It's the first decline in nearly a decade as inflation catches up with the second biggest shopping season. In an online poll of more than 1,000 parents nationwide, consumers are focusing on school supplies and other necessities, with the average spend for each child expected to be nearly $600. That's down from $661 in 2022.
Thanks, Kimberly. Those are the company stories we're following this hour. I'm Steve Rappaport, and this is Bloomberg.
You're listening to Bloomberg Markets with Paul Sweeney on Bloomberg Radio.
All right, Madison Mills and Paul Sweeney here in the Bloomberg Interactive Brokers studio. Got a nice little market rally, a melt up this morning. The S&P up 1% on the back of that tamer than expected inflation data, as you know, some of our guests have said this morning. Pretty solid reading across the board, maybe giving the Fed, some reason to pause after this potential rate hike in July, and that's kind of what we're seeing in the marketplace here today. We'll have more on that coming up. Right now, let's head down to Washington, D.C. We'll get world and national news with Nathan Hager.
And we'll get you more on the NATO Leaders Summit in Lithuania here, Paul. It is day 2, the final day of the gathering, and Ukrainian President Volodymyr Zelensky's there as a guest, but he says it's been a success.
And I'm grateful to all leaders in NATO countries for very practical and unprecedented support.
President Zelensky spoke alongside a group of 7 leaders who announced new security guarantees. Bloomberg's Maria Tadeo, though, reports Ukraine didn't get everything it wanted, like a timetable for an invitation to join NATO.
There was going to be no formal invitation for Ukraine. It's clear to everyone the country is at war, and it was clear from the beginning. Remember, the president was very clear on this. On the Sunday, you cannot get into direct confrontation with Russia as NATO. That would be incredibly dangerous for the world.
Bloomberg's Maria Tadeo reporting there from Vilnius. President Zelensky now says he knows Ukraine won't be able to join NATO until, quote, our land is safe. FBI Director Christopher Wray is appearing on Capitol Hill for the first time since Republicans took control in the House. He is testifying before the House Judiciary Committee, which is led by Republican Jim Jordan. He says they're going to examine the politicization of the Bureau under Wray and Attorney General Merrick Garland. Former President Donald Trump tapped Wray to be FBI Director after he fired James Comey in 2017. There was a bad crash overnight in southern Illinois. It left 3 people dead, 14 others hurt aboard a Greyhound bus. State police say that bus ran into 3 tractor trailers that were parked along a rest stop on westbound Interstate 70 just east of St. Louis. David Cherno is one of those truck drivers.
I was in the air when I woke up, and I'm not saying woke up, just kind of trying to wake up. And then I got up, got my shoes on, and there was a gentleman that got out of the bus. And then we went and tried to help assist get everybody out of the bus.
Everybody hurt and killed in that accident, police say, was on the bus, though they don't know whether the driver was one of them. Anchor Brewing, it's closing up shop after 127 years in business. Anchor is the self-proclaimed first craft brewery in the U.S. It's filed for a form of bankruptcy known as an ABC. The San Francisco-based brewer is best known for brands like Anchor Steam, Old Foghorn, West Coast IPA. Anchor says it was severely affected by COVID with a particularly long impact in the Bay Area. Global news, 24 hours a day, powered by more than 2,700 journalists and analysts in over 120 countries. I'm Nathan Hager in Washington, and this is Bloomberg. Paul?
All right, Nathan Hager, thank you so much. We appreciate it. Madison Mills and Paul Sweeney here. Time is money, Madison. You ever heard that?
I have heard that.
Shopify thinks it's the case.
Shopify does, and they have created this tool that goes into your calendar app, basically, so that when you create a meeting, when you're in your Google Cal, this widget calculates the cost of that meeting in terms of time taken away from employees' actual work that they're able to complete. I'm looking at a tweet right now that shows one of the estimated costs from a Shopify meeting hit over $2,100 for one of these meetings.
So they're saying a typical 30-minute meeting with 3 employees can run from $700 up to $1,600. Adding an executive like the COO can shoot that cost above $2,000. So the COO is saying, hey, no one at Shopify would expense a $500 dinner, he said, but lots and lots of people spend way more than that in meetings without ever making a decision. The goal of this thing is to show you that time is money. If you have to spend it, think about it. So they're just really trying to cut down on the number of meetings they have because they're saying, hey, time is money. Think about it that way.
Yeah.
And think about whether you really need to have that meeting. So, I mean, the company's on pace to cut about 322,000 hours and 474,000 discrete events in 2023. I didn't know people had that many meetings.
I didn't know meetings were that costly for companies,
Exactly.
but I'm all for this take. I love it.
Yeah, time is money.
Yeah.
We'll see about that. This is Bloomberg.
This is Bloomberg Markets with Paul Sweeney.
We got a lot of green on the screen here, but the volume is light. This is a market that's much more optimistic or bullish than maybe central bankers are. 9.5 million job openings. What are people doing? Are they just sitting in Starbucks all day?
Breaking market news and insight from Bloomberg experts.
There's still some concern out there in the market that there is room for things to deteriorate a little bit more than what they're indicating.
As small and medium-sized businesses struggle, they don't present as much competition.
What are you guys thinking about hardware, software? How should investors approach this thing called AI?
This is Bloomberg Markets with Paul Sweeney on Bloomberg Radio.
All right, coming up in this hour, we're going to break down the markets. Nice move higher here with Jess Menton. She's equities reporter. She'll join us and give us her color on what's happening on the market. And then Ira Jersey, chief U.S. interest rate strategist with Bloomberg Intelligence. He'll break down that the CPI data and the Fed's likely next move. And our C-suite conversation of the day, Greg Friedman, CEO of Peachtree Group. I'm going to guess they're in Atlanta because every street in Atlanta is named Peachtree. He's going to discuss the commercial real estate business. I don't know what you do in commercial real estate these days. I just see signs out there saying space for rent everywhere you go. It's got to be tough business. We'll get the latest there. But first, let's kick things off with Denise Pellegrini, the Bloomberg Business Flash.
Hey there, Paul, and we do have some celebrating on Wall Street as investors look at that weaker than expected report on inflation. It's 11:01 on Wall Street. We check the markets for you all day long here at Bloomberg. We also have some volatility in currency markets with the dollar index hitting a 14-month low and also the pound strengthening to $1.30 in the cross. That was for the first time in almost a year. We're watching that as well. And as for that inflation report, the June report on consumer prices showing overall inflation easing up 0.3%, including prices on food and rent not going up as fast as they were in June. And airfares, believe it or not, they actually fell. But don't expect the Fed to lay off the rate hikes just yet, according to Bill Dudley, former U.S. Fed president and current Bloomberg opinion columnist.
Remember, goods prices went up dramatically because during the pandemic, people bought a lot more goods and bought a lot less services as they stayed home. Now we're on the flip side of that. They're buying less goods, more services. So goods prices are very weak and are going to be very weak for a while as people manage their inventories down. But once that comes to an end, then goods prices will level off. And so the benefit to headline inflation from falling goods prices will be over. And you'll be stuck with what's happening in the services side.
Yeah, and Dudley commenting with us there on the Bloomberg Surveillance podcast. Investors, though, they don't appear to be listening to Dudley. The Dow, it is up 287 points. That's about 0.8%. The S&P 500, it's up about 45 points right now. That's about 1.2%. The NASDAQ, the big winner on the day, once again, up 197 points. That is 1.2%. The yield on the 10-year Treasury now, let's call it almost 3.9% there. Spot gold, it is higher, up about 24 points. That's about 1.25%. And crude oil, it is also higher this hour. And in the housing market, another report showing home prices hit a new high in June. So not seeing any lack of inflation there. Zillow says a typical U.S. home value, it crossed the $350,000 mark in June for the first time. Inventories still cite homes are sitting on the market one more day than they were in May. So I guess you could call that a little bit of a slowdown in demand, but I mean, a day, really, not much. And that is a Bloomberg Business Flash.
All right, Denise Pellegrini, thank you so much. We appreciate that. Madison Mills, Paul Sweeney here in our Bloomberg Interactive Broker Studio. You can also see us streaming live on YouTube. That's the internet. You can go to YouTube, search Bloomberg Global News, and that is where you'll find us. Nice day in the markets, as Denise was just reporting. Let's check in with Jess Menton. She's Bloomberg's equities reporter. She joins us here in our Bloomberg Interactive Broker Studio. Lots to talk about out here, Jess. What's happening when you take a hard look at this market today?
Well, obviously, when you look at the industry groups in the S&P 500, you're seeing all 11 sectors higher, led by more of these riskier corners of the market, communication services, so definitely known as a growth-oriented area when you think of what's housed in that particular index when it comes to Meta. And then also Google. Then you see other cyclical areas that are also rallying, like materials, technology also up more than 1%. But when you are looking at with this CPI report, so it's interesting because, Paul, you and I were talking about yesterday this anniversary story that Elena Popina and I actually wrote. So we're taking a look at...
You have a day job?
Yeah, I do. I have another job when I'm not here with you and Maddie.
She has several, actually. She's all over the place.
So this is the data for June, obviously this past June. If you look at a year ago's data from June of 2022, that's when CPI peaked at just over 9%. And so what I was chatting with Paul about yesterday is that Luthold Group crunched the numbers on this. And typically throughout history, if you go back to the early 1950s, anytime CPI has peaked, the average return for the S&P 500 a year later was about 13%. So if you use that based on when the data came out a year ago, the S&P 500 is actually up more than that. So it did indeed rise more than, rose actually double digits, but actually up 17% since that report came out that showed that CPI did peak. At the time, obviously, we didn't know if that was going to be the peak or not, but obviously you saw investors moving well ahead of that. So the question being how much of that is priced in so far. But if you want to look at the S&P 500 as far as where it stands from its highs of last year, it's actually just off about 7% from its record in January of 2022. And it's also trading very close to 4,500. So that would be its highest level since April of last year.
So what can we expect from the start of earnings season and the impact that could have on some of this great performance that you're telling us about?
Well, some of the other groups that are moving big on this is also when it comes to the financial sector. That's up more than 1%. If you look at the BKX, so that's going to include big banks as well as some regional names in there too, up more than 2%, but that gauge is actually down close to about 17% just because of the pummeling that it went through, obviously in March because of those bank stresses. But if you look at names today, Citigroup, ticker symbol C, that's up about 3%. And then also some of these other names, when you think of more of those regional names like Zions as well as Comerica, both of those up about 4%. So this is obviously leading into JP Morgan and the other big names that are reporting on Friday. So that's going to be a big indication, obviously, of the health of the overall economy just because of their lending standards. But something Gina Martin Adams, Bloomberg Intelligence, obviously, Paul, because I know you and you like they crunch numbers, something she said that was really interesting in their outlook when it came to second quarter earnings season is that there is this expected weakness in financials, but that doesn't necessarily mean that it's going to bode well for the rest of the earnings season. If you look at technology, which in growth corners of the market, which really have been pummeled over the last year, they actually look brighter times ahead when you're looking at their growth outlook. So she was sort of using the counter argument where obviously you want to see the banks hold up well. We have to keep a close eye on those net interest margins as far as a bellwether for what that means. But even if you see weakness in financials, that doesn't necessarily completely ruin the tone for earnings season. And you might actually see other things improve more beyond when you're looking at other corners in the market.
So I need to get to this Domino's Pizza story.
Yeah.
I mean, it's a $13, $14 billion company up 10% today. They signed a deal with Uber for delivery. And here's something that I want to ask you guys about, because this is more in your demo. This is a comment from Russell Weiner, the Domino's CEO. Given certain customers only order their delivery from the Uber Eats app, this deal could make Domino's available to millions of new customers around the world. That statement that some customers only order their delivery from Uber Eats, is that true?
I feel like we're diversified, right? We've got DoorDash, Seamless, Uber Eats.
I have a few different apps that I will go through depending on what I find is the cheapest at the time. Kind of like what I do with ride-hailing apps.
Exactly. We're cross.
So you go like you arbitrage Uber Eats against what?
Uber Eats, DoorDash, Seamless.
Yeah, all
a
the
diverse
above.
portfolio. Yeah,
right.
Grubhub.
So I do the same
if you're
thing.
abroad.
You know, funny enough.
Okay, here's it. Because the reason I asked it, I don't order out stuff for delivery.
Not at the Sweeney compound?
Never, because it just the cost.
What
Doesn't
if you don't have food that day?
Too far out.
Like, what do you do? You have to leave the house?
Well, first of all, I shop and we've got food in the house and we cook.
But like as a backup, like
as
what
a
if
backup, you go out and pick up a pizza. You go out and get a sandwich.
You get in the car.
Yes.
We don't have that.
Hey, you know what? Papa John's, ticker symbol PZZA, it's actually down today, close to about 2%. So that happened as it adopted a third-party partnership. So moving in a little bit of a different direction than when we're looking at Domino's.
Right. See, I just the value proposition isn't there for me. If I buy like a $15 order sandwich,
right?
I'm paying $5 to have it delivered or $7 to have it delivered. Yeah. Are you nuts?
I know.
I just don't get it, that value proposition. But I know that's
you know. Sometimes if we're lazy, it's more of the convenience,
which is every day of my life.
All right, I'm learning. I'm learning from you guys. So that's good. Jess Metton, thanks so much for joining us. Jess Metton covers the equities She's a DoorDash expert as well, so we appreciate getting some thoughts there. All right, let's go to Ira Jersey. You're talking old school. I talk Ira Jersey. I mean, this guy, he's got a little sport coat he keeps down in Princeton in case he needs to get on TV because he comes super casual. But he joins us from Princeton. Ira Jersey, Chief U.S. Interest Rate Strategist. Ira, heck of a good print there for people that are, I guess, calling for a Fed to kind of hold off a little bit. What did you take away from the inflation data we saw this morning?
Well, first, let me say, Paul, that I'm with you. Let's go out and get our food, and if we want to bring it back for the family,
This is because you guys don't live in walk-ups, okay? This is the key indicator here.
I gotcha. I guess that's true.
Go ahead, Ira.
So the inflation print was obviously good. Like members of the Federal Reserve are going to like it. They're going to say, okay, we're heading toward our goal. We're not there yet. I think that's some of the Fed speak that you'll hear is that we're not out of the woods, but this is a certainly decent data, and the market reaction to it I think is pretty appropriate. You know, very significant rallies in the front end of the yield curve. So you're looking at 2-year, 3-year, 5-year rates. 15, 18 basis points lower at some points during the morning. And that's basically pricing out a second 25 basis point hike late after July.
So what is the single most important data point for the Fed to make that September decision based off of?
Yeah, there's not one, right? So, the Federal Reserve, like most of us, we look at a mosaic of data that's coming in, but it certainly is the different inflation prints and those things that affect the inflation print. So last week's jobs number obviously was one of them, because even though, when you look at the whole pantheon and of the data that we received today, in terms of the CPI report, services growth, even though it's slowing, is still reasonably high. And you look at core services, so that's services excluding, say, shelter costs, and you see that actually is still growing at a reasonably decent pace, and that's very impacted by how many jobs there are, what wages are doing in those services sectors. So I think that there'll be a very meaningful view of that when we get both the July and the August data. Because remember, before the September meeting, we'll get both CPI and the jobs report for 2 more months, for both July and August. So it's not any one of those prints. It's, I think, the continuation, and do we see a continuation of this moderation in some of these data?
And of course, Ira, looking at the world interest rate probability function on the Bloomberg terminal, the WIRP, the market is kind of taking down its expectations pretty dramatically for a second rate hike after this potentially one in July. Does that jive with kind of what you're thinking?
Yeah, it is, and it has been. One of the things that Anna Wong and I had talked about right after the Federal Reserve meeting in June was whether or not the dot plot, which was suggesting that there were going to be 2 more 25 basis point interest rate increases this year, whether or not that second one in particular was just jawboning, trying to get rid of some of the cuts that were priced into the market. And I think that's. I don't think it's clear that that's what they were trying to do, but I think that certainly is what happened in the markets. Was you not only priced in 1 more interest rate hike, but you priced out the potential for cuts anytime this year. And I think that's really one of the policy decisions that the Fed needed to do. Now, I think there's other ways the Fed could have communicated that other than saying that they were going to hike more. They could have just said, look, we're not going to cut interest rates until the unemployment rate is above 5% or something like that, and give some kind of target for what the minimum what the minimum is for different economic indicators for the Federal Reserve to make a downward move in rates. And I think we're nowhere near any of those trigger points at the moment.
When we got the Fed minutes, it became clear that there was definitely some division amongst the voting members when it came to the last rate call there. And we get the Fed Beige Book later this afternoon, which might give us some more details on that. But Ira, talk to me about whether a print like the one we got today leads to more division amongst the voting members or less.
So I think if the Fed does increase rates 25 basis points, that it's possible after this kind of print, maybe you get 1 or 2 more dovish members say that, hey, we should be done. But I suspect that July is basically a done deal. You won't get any dissents for July, at least based on the data we have right now. I think it can become more contentious going forward. So when we reach September and November, if the inflation data comes in closer to, say, on a month-to-month basis, 0.3%, do we end up with some members saying, well, we still have to hike more because inflation is still not near our target. It's still running at 3.5% or 4% year on year. So, do we need to? We should be hiking more. Whereas you have other members saying, look, we've done a lot. We have to give it some time. Let's see. Let's wait and see for a little while. I think ultimately those wait and see people will win out. That's our call right now. But obviously, like you mentioned, there is a lot of data that we're going to get between now and September, and then certainly the November meetings.
So, Ira, if the data stays roughly the same as kind of what we're seeing right now, is a rate cut not to a 2024? Is that the kind of event we should be thinking about, or a time frame we should be thinking about?
Yeah, and I even think late 24.
Really?
I think that I think the Federal Reserve might not, be thinking about really cutting until the third or fourth quarter of next year, unless something significantly changes in the job market. Remember, the Federal Reserve, unlike some other central banks, is really only concerned right now is only concerned about inflation. But it would be concerned about the job market if you saw the unemployment rate go up significantly, and if you saw certainly job losses. And we still don't have job losses, right? So until you start to see non-farm payroll be negative, I don't see a reason why the Federal Reserve would necessarily be thinking about cutting at this point. Because in a situation where interest rates are at 5% in the Fed funds rate, inflation's 2.5%, and the unemployment rate is right where it is now, that's a great situation for the Fed. I think the Fed would be very happy with that situation, quite frankly.
All right, important stuff. When and where can I see Lionel Messi play for Inter Miami? When does that start?
That's a good question. I have not kept track. I'm not a Messi tracker or anything like that. We're in the middle. We're just at the very end of our USL League 2 season here at Real Central NJ. So we have our last home match tonight. So that's been my.
Oh, really? Okay. Who do you guys play?
We play Westchester United from Westchester, Pennsylvania. We had a game against Philadelphia Lone Star on Monday, which ended up pretty well for us with an Olympico, and you can look that up.
An
Paul.
Olympico.
I'm sure you're interested in seeing what an Olympico is.
Okay, Real, Central New Jersey, good stuff there. That is minor league soccer. Ira Jersey's all over that. He's our soccer guru, and he also does this interest rate thing on the side as well. Ira Jersey, Chief U.S. Interest Rate Strategist for Bloomberg Intelligence, joining us from the BIHQ down there in Princeton, New Jersey. Again, just kind of looking at the yield space, as Ira's mentioning, we're seeing a big move. Rates come in on the short end of the curve. The two-year Treasury is off about 14 basis points, 4.73%. Remember, we had north of a 5% print on the two-year just a week or so ago, so a big move down in rates. 10-year down about 10 basis points, 3.87 on your 10-year. We're going to have more coming up. This is Bloomberg. Let's get some company news right now with Steve Rappaport.
Paul, Goldman Sachs is breaking its golden rule when it comes to earnings. Goldman executives are actively downplaying expectations for quarterly results that will be disclosed next week. Over the past 6 weeks, Goldman has signaled a 25% slowdown in trading revenue, highlighted material markdowns in its real estate book, and said it will take a hefty write-down as it sells the Green Sky lending platform. Shares of Goldman Sachs currently up more than 2%. Hollywood writers dropped their pens in protest as they remain on strike, and the industry is bracing for actors to go off script as well. Bloomberg's Gina Cervetti reports.
Steve, Hollywood could face 2 simultaneous strikes for the first time in 63 years if the union representing actors can't come to terms with studios on a new contract. SAG-AFTRA agreed to bring in a federal mediator to help break the impasse, but it says members will not work beyond midnight when the current deal expires. Residuals from streaming platforms are a big sticking point. Performers want a significant boost in payments to reflect the success of shows. Studios argue many of those platforms have yet to be profitable. Steve?
Thanks, Gina. A hefty price for a pointless meeting. Shopify has rolled out a calculator embedded in a worker's calendar app meant to shame them with calculating the cost of any meeting with 3 or more people. It determined a typical 30-minute powwow with 3 employees or more can run as much as $1,600. For the past year, Shopify has been determined to reduce what it describes as unnecessary gatherings. The e-commerce company eliminated all recurring meetings with more than 2 people. And those are the company stories we're following this hour. I'm Steve Rappaport, and this is Bloomberg.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
And it is 11:20 on Wall Street. We check the markets all day long for you here at Bloomberg, and investors are celebrating a weaker than expected report on inflation. We're bringing you all the details about it this hour, and stocks are rising on that report. We're tracking it all for you here on Bloomberg Radio. I'm Denise Pellegrini. And just hold on for 1 second here. We got a little bit. Okay, the Dow, it is up 261 points. The S&P 500, it is up 43. And the NASDAQ, it is now up 179. Inflation for June coming in weaker than expected, as we have been reporting. And I'm Denise Pellegrini. This is Bloomberg here on Bloomberg Radio. We're having a little bit of some technical problems, but we're going to get it all straightened out. Head of U.S. economics at B of A Securities. He says he does need to see more before the Fed can lay off the rate hikes.
For me, it's about broad-based disinflation across services. Yes, we should get some payback in goods prices. We saw that again this month with used cars. But can we get a combination of disinflation in services? So beyond shelter, I agree with you. I'm not sure airline fares fell 8% on the month, but is it broad-based enough to make you confident that the new trend, or we're back to our prior trend of roughly 2%?
Yeah, we've been talking about those airfares because they fell 8% according to that report, though as a consumer, you might not have been seeing that. Let's check the markets again. The Dow up 272 points in response. The S&P 500 up 44, and the NASDAQ, it is up 181. The yield on the 10-year Treasury right now up just almost 3.9%. Crude oil futures, they are also rising right now. And spot gold, it is higher as well. United Auto Workers opening contract negotiations with GM, Ford, and Stellantis in the coming days, and this is for new worker contracts. A prolonged strike, of course, could be very expensive and cost automaker billions of dollars, but we're not seeing it too much in the stock for those companies right now. Ford, it is up about 0.4% right now. It has been up every day this week so far, and GM shares are on quite a run. They're up more than 2% right now, and shares, guys, of GM, they are higher for a 12th day in a row. And that is a Bloomberg Business Flash.
Denise Pellegrini, thank you so much. We appreciate it. Madison Mills, Paul Sweeney here in our Bloomberg Interactive Broker Studio. All right, Madison, our next guest came in, and I was a smidge rude. I would say he's in the commercial real estate business. In my usual New Jersey snark, I said, you couldn't pay me to invest in commercial real estate.
But to be fair, everyone would agree with you.
I don't know, man. He's in here putting money to work. Greg Friedman joins us. He's the CEO of Peachtree Group. They own a lot of commercial real estate, including a lot of hotels. Greg, so put me in my place here. Talk to us about the health of the commercial, or the status of the commercial real estate business today, because it just seems like every commercial building I go in around the country, I see the sign out front saying, 3,000, 10,000 square feet available. Talk to us about the state of the market.
Yeah, sure. It's a great question. And there's definitely a bifurcation across commercial real estate today. So, not all asset classes within commercial real estate are equal. So you have office that's going through a lot of secular distress. The return of office has been slower on the recovery. And then you look at the hospitality industry, going through the pandemic, had its worst, from an occupancy perspective, it was at the worst level of all time, and now it's recovered extremely well. So, there's been a robust recovery across the hospitality space. And then you look at, multifamily, industrial, self-storage, those asset classes continue to do really well across commercial real estate at the asset level. Now, with that said, there's a lot of balance sheet distress that's, taking place across all commercial real estate assets today, just given how fast the Fed has increased interest rates. So you've seen, rates have gone up a good 500 basis points, and that's putting a lot of pressure on the underlying, valuations across commercial real estate assets, because ultimately, typically, about 270, 280 basis points above the risk-free rate is where cap rates for traditional commercial real estate assets, that's where they trade. And right now, the risk-free rate's around the 10-year Treasury rate, which is 4%. So when you look at, I think it came down a little bit with inflation moderating today, but still it's around 4%. So ultimately, a lot of commercial real estate assets had experienced this just robust increase in valuations during the pandemic when interest rates went to zero. Now we're on the other side of that trade. And so I would argue that there's more balance sheet distress right now across commercial real estate with loans that are maturing because there's a huge wall of debt maturities that are taking place, and that's a bigger impact than just what's happening just across, again, you have some secular distress in office, but outside of that, most of the other asset classes are doing well.
So Greg, you mentioned that there's some opportunity still in the hotel space, and I have to talk to you then about a story that Paul and I love so much, which is the bankruptcy filing of Jimmy Buffett's Margaritaville Hotel in Times Square. Okay, they had to refinance about $300 million of debt that was tied to the project. If a hotel like Margaritaville in Times Square can't make it these days, who can?
Right, and I think that's a classic case where there's a lot of debt on that property. It's facing that balance sheet distress with loan maturities, higher interest costs at floating rate debt, and so that's more of a balance sheet issue per se. I don't think it necessarily represents what's happening at the asset level and the performance, and that's I would say it's more of a one-off scenario than what's happening across on a macro scale. What's happening across the hospitality space. So there's definitely that balance sheet distress, but ultimately the way I look at the real estate space today, to me, the better place to be investing is in the credit side of the business, because there's a huge trade there where you can go out and directly lend to groups because the banking market's pulled back. In a lot of cases, you can lend and be getting equity-like returns where you're leveraging closer to call it 50 to 70% of that acquisition cost.
Talk to us about your hotel holdings, your businesses there. What kind of hotels do you own? Where are they, and how are they performing?
Yeah, sure. So, our assets, we own a lot of hotels across the U.S., so it's pretty diversified. We do have a heavy presence in the Southeast. Nice. We have a lot of, hotels across, the Midwest, in Texas, as well as out in the West Coast in Arizona and so forth. But, most of our assets are in the Southeast, as well as some in the Mid-Atlantic. But we own a bunch of hotels on the equity side, but we also have a huge portfolio of assets that we have invested on the debt side, where we have first mortgage loans, where we've originated most of these loans, where we bought loans during the pandemic.
Yeah.
We were one of the biggest buyers of debt during the pandemic, where we bought over 180 loans from different financial institutions, primarily banks. And we also did a lot of direct lending, obviously, throughout the pandemic, as well as even today on hotels. And we also finance other commercial real estate assets on the debt side, too, today.
What is the customer demographic looking like for most of your hotels? Would you say more middle to low income? What's the range?
Yeah, so most of our hotels, are really catering towards, a balance of corporate travelers as well as, where we have a fair amount of leisure travelers as well. It's mostly mid-scale hotels. So it's really, really catering towards the, I would say more the, mid-scale traveler that's traveling across the U.S.
So then are you feeling any impact of the decline in popularity of Airbnb yet in terms of occupancy, or is that something that you're not anticipating feeling just yet?
Yeah, it's a great question. So we've seen, just across, because Airbnb has been a discussion over the last, 6-7 years.
Yeah.
And it really hasn't impacted our hotels as much. There's been an impact on the ability to drive rates on these sellout nights. So when there's, say there's the Super Bowl or there's some type of one-time event in a market, there's this phantom amount of supply that comes in the market through Airbnb that ends up impacting our ability to drive rates. But given the type of hotels and our customer mix, most of our customers like staying at our hotels because they have, they have a consistency of service. They know exactly the products, as well as, we own a lot of Marriott, Hilton branded hotels, and they like to get their points.
All right, so what do you think, or how bad do you think the credit side of commercial real estate is going to be? We heard a lot about it it's going to be a real problem for a lot of banks. At some point in time, you think there's going to be a bunch of this debt coming due, and boy, it's going to be tough to refinance it at these higher rates, and the value of your underlying property is much lower than it was. You have loan-to-value issues. How bad is that going to be, and when do you think that's going to really hit the system?
Yeah, I think it's it's going to be, personally, I think there's going to be this wave of, debt maturities that are going to create a lot of challenges. So, I mean, I think, how bad it's going to be, it's hard to tell at this point. I think there's no question 40% of the liquidity in the market for debt typically comes from, national banks, the regional and the community banks. They're just not able to lend because a lot of them are trying to shore up their balance sheets. And so ultimately, I think, there is going to be, I think there's going to be a lot of opportunities for private lenders like us to fill that void. I think that's going to put a lot of pressure on different real estate owners because they're going to have to pay higher spreads. They're going to have to pay their ultimate interest rate costs because interest rates, the index rates have moved up so much. They're going to have to pay higher expenses there as well. And so, I do think there's going to be a lot of challenges. And today, you look at the market, there's like $1.5 trillion of loans that are maturing between now and the end of 2025.
Wow.
And so I think you're going to see, over the next 12 months, you're going to start seeing a lot more situations like the Margaritaville situation in Times Square.
All right, 30 seconds. How big is your lending business versus your portfolio of real estate
Sure.
holdings?
So right now our lending business, so our debt investments make up about 60% of our AUM, and so that's a big part of our investment book today. And
you guys are private, right?
We are private.
When are you going public?
We have no desire to go public anytime soon, so we are very much focused on staying a privately held company.
How do you get funded? Where do you get your funding from?
So we sponsor different investment vehicles, and we typically have just internal capital along with a lot of capital that just comes in from different investors that invest in these vehicles.
Well, back
Internal
in my banking
capital,
days, I would have
huh?
pitched this guy hard
Oh,
to go
yeah.
public, and I would have taken you public. All right, so appreciate it, Greg. Really, really helpful to us today. We really appreciate getting your perspective here. Greg Friedman, he's the CEO of Peachtree. It was Peachtree Hotel Group. Now it's Peachtree.
Yeah.
Peachtree Group. We're just going Peachtree Group. All right, appreciate it coming in here, Greg. Right now, let's head down to Washington, D.C. We'll get world and national news with Nathan Hager.
All Ukraine is getting new long-term security guarantees from the U.S. and other group of 7 nations. President Biden announced them on the second day of the NATO Leaders Summit in Lithuania.
We're going to help Ukraine build a strong, capable defense across land, air, and sea, and from which will be a force of stability in the region and deter against any and all threats.
The president will have more to say this afternoon in a major speech at the conclusion of the NATO summit. Bloomberg Government's Jonathan Tamari reports the president may have a domestic audience in mind.
One of the key elements might be his promotion of the way he has, guided essentially the world powers, the Western powers, to support Ukraine and stand up to Russia. I think he sees that as a major success, a major foreign policy credit to himself that he'll probably be campaigning on. And so this is an important moment for him to try to emphasize that.
Bloomberg Government's John Tamari in Washington. The president's speech is set for a little bit more than an hour from now, about 12:45 Wall Street time. You'll hear it live on Bloomberg Radio. Turkish President Recep Tayyip Erdogan says Sweden's accession into NATO won't be approved till October. Turkey dropped its objections to Sweden's bid at the summit after getting assurances on its handling of groups that Turkey considers terrorists. The Turkish parliament still has to ratify Sweden's entry. Nearly a quarter of the U.S. is facing scorching temperatures this week that show little sign of let-up. From California to Texas and Arkansas, about 46 million people are under excessive heat warnings. Another 36 million are under heat advisories from Missouri in the north on south into Florida. The Texas electric grid is expecting near record demand with temperatures above 100 degrees and a heat index as high as 111 in Houston. Global news 24 hours a day, powered by more than 2,700 journalists and analysts in over 120 countries. This is Bloomberg.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
And it's 11:40 on Wall Street. We check the markets for you all day long here at Bloomberg. And about inflation, it's not that prices are getting cheaper. They're just getting higher at a slower rate. That has investors celebrating a little bit. Some celebrating as those inflation pressures ease. Inflation for June coming in weaker than expected. Ira Jersey, chief U.S. rate strategist for Bloomberg Intelligence, calls it a good sign for those hoping the Fed will stop hiking soon.
You know, with this kind of data where, you know, the Fed has to be pretty happy actually about what they're seeing. So even though they're probably still kind of committed to hike in July, you know, the question is, will they hike then again in September, November? And I think that that's very much in doubt at this point when you get really a low core print. So when you look at the core print, it was actually under 0.2%. It only rounded up to 0.2%. So it's actually a pretty decent print overall.
And Jersey there on the Bloomberg Surveillance podcast with Tom Keene. Stocks, as we've been talking about, they are higher. The Dow right now, it's up 164 points. The S&P 500 up 28. The NASDAQ, it is up, 110 points right now. And after those consumer prices, including prices on food and rent, not going up as fast as they had been, the consumer price index, it rose 0.3% last month from a year ago. Prices on airfares, guys, they actually went down in that June report. Energy prices are rising, though. We did have Brent crude this morning rising above $80 a barrel for the first time since May. And checking on NYMEX crude right now, it is also up about 0.5%. 75.43 a barrel right now. The yield on the 10-year Treasury right now, 3.86%. Amazon shares, they're up about 0.5%. Amazon Prime Day pushing U.S. online sales up 6% in the first 24 hours. That sounds pretty good, right? But that did fall short of estimates. You might ask what people are buying. Well, home goods, household essentials, apparently the best-selling categories for Amazon in the first 24 hours of Prime Day. And that is a Bloomberg Business Flash.
All right, Denise Pellegrini, thank you so much. We appreciate it. Madison Mills, Paul Sweeney here in our Bloomberg Interactive Broker Studio. We are streaming live on that YouTube thing. You can go to YouTube and search Bloomberg Global News.
Global
there
News.
You go. Boom.
Yeah.
That's easy. All right, in this segment, we're going to talk Big Pharma and fine French wine. Watch how I bring this all together. Sam Fazeli, head of European research. He's also the pharma analyst over there for Bloomberg Intelligence. He's based in London, but we got him here in New York. He's probably scouting out some wineries here. Sam, let's start with the pharma stuff. You've been covering these names for a long time. Can I make money buying these big pharma stocks?
Well, I mean, Paul, if you look at some of them, as we were just talking about Eli Lilly, you would have made, what was it, 400, 450, 500%?
Yeah.
Absolutely. So now, but now we're in a little slightly different situation in that a lot of these stocks have done what they were going to do. Large pharma is heading into an uncertain period, which is not new because we've been talking about the Inflation Reduction Act, etc. And for some of the Europeans, if you step away from the US, you have the dollar that's kind of become a bit of a headwind when you go into second quarter results. So, and then on top of all of that, you've got this other issue, and that's this sector switch, this switch from perhaps defensives to at least technology. I'm not going to say necessarily.
So there's no AI play in pharma?
The AI play, you know, pharma's probably been using AI for a long time, right? Doing this and that, but it's not immediately apparent.
Yep.
Well, Recursion, no? This week, Recursion doubled in the day after NVIDIA invested $50 million, but that's small for you?
Well, I mean, that will play into the large pharmas, right?
Yeah.
But it's not really. Tomorrow, if Eli Lilly woke up or Merck woke up and said, no, we've got this amazing AI thing that's going to discover molecules. Okay, show me. Yeah. When you've got it, show me the drug that's going to go 10 billion and you develop from AI. I don't really care how you develop the drug. If you're going to speed up your R&D, reduce your R&D as a percentage of sales, that's what I care about. Show me.
Where are you guys looking for the next big breakthrough? Is it cancer? Is it obesity? Is it dementia? I mean, there's so many areas out there that if someone could invent something, the cure-all, wow.
Yeah. Cure-all, I don't know.
I think the reason I asked this, man, is he's a scientist. He's got a PhD in some kind of something wasted. Wasted a lot of time. But here he is on Wall Street.
Too long ago. But you know, Paul, one of the things is that I think, unfortunately, the answer to your question is very easy, which is not the way I like to go about this. It's everywhere.
Yep.
You can see it in obesity. You can see it in cancer. You can see it in dementia, although those are baby steps at the minute from the way I look at it. You can see it in treatment of psoriasis. Every aspect of medical science, pharmaceuticals, diagnosis, they're all evolving at a pace. And that is the problem, in that we keep coming up with great innovation and we don't have enough money to pay for it.
I feel like Ozempic, though, has totally exploded as that's my big analyst take there. How big is that industry going to potentially get in terms of the obesity story?
Well, I think my colleague Michael Shaw has got this phenomenal obesity model that he's been working on. He's talking about 44, 45 billion, not necessarily just for Ozempic.
Yeah.
There are those who talk about 100 billion sales. The reality is we do have a situation here which is probably exactly what you need from pharmaceuticals. You have a problem you can prevent.
Yeah.
Of course, people should eat less, should eat better, etc. But let's put that aside. You have a problem you can prevent: cardiovascular disease, future diabetes, by losing weight. Is it worth spending $12,000 a year on that to make someone reduce the risk of someone in 10 years' time having need to go to hospital every other week for whatever cardiovascular disease they have? The answer is yes. So that's the thing that I think why these drugs are, assuming they're safe and continue to be safe, are revolutionizing and is doing what we want to do. We want to prevent people going. We want health care, not disease care.
Right, that's a good point. All right, so I know one of the headwinds that when I read your research and listen to what you have to say, is some of these big, or just drugs in general, coming off patent. And there's always this kind of cliff out there when drugs are coming off patent. Where are we on that? Are there certain names that are particularly exposed to that?
Yes, I mean, you've got Pfizer, for example, as being one of them. You've got Merck with drugs, a key, massive drug called Keytruda, actually, potentially coming off patent in the US in 2028. So there are significant drugs. And we're dealing with one right now for AbbVie called Humira. And that is a fantastic drug for the treatment of arthritis and several related conditions. And that's coming off patent. The problem that pharma has it's not just about patents anymore. It's about how the Inflation Reduction Act is going to impact the life of their products before price controls step in. So now we have two things to juggle: the patents and the impact of IRA.
Okay, let's get to the important stuff. You live in Bordeaux. I think that's in France. I think they grow wine there. How are things in Bordeaux? How's the wine the last several vintages?
Right. In a nutshell, 2022 is the one that we're just tasting right now. Yeah? And I'm just going to say it really quickly. Last year I was going, oh my God, how is this going to happen? We had wildfires.
Yep.
Smoke everywhere, wafting over these beautiful vineyards. The wines, not across the board, but some of them have ended up amazing. The ones that are scoring through not just one critic, several critics, at almost perfect or close to perfect. And they're, strangely, some of them are affordable. I mean, depending on what sort of budget you live on, obviously. Right. But, that's what you expect these super wines to be out of reach for the majority of people. But some of them are becoming a little bit more affordable this year. The best wines aren't just the ones that are the $1,000 bottles and above.
Right.
So,
which are in your cellar. What are you drinking these days?
Yeah.
Last night, am I allowed to name a name?
Sure.
Okay. Last night I had a very nice fresh bottle of Clos Duval. It's California.
Yep.
2017. Beautiful structure, nice freshness, and you and I can go and have one tonight.
Okay, all right. That's a deal.
I love that for you guys.
Yeah, Redo won't mind with the Amex card.
Not at all. No, just put it on there. Sam, let's see. We've got 1 minute left. I'm going to continue on the wine trek with you because I'm curious. When you're in the States, is there a wine that you're particularly excited about getting that you can't get back at home?
Oh, that's tough. Remember, I live in the middle of England.
I know.
UK, but also Bordeaux. But Bordeaux is tough for anything outside Bordeaux.
Yeah.
London, it's it's the place you get access to so much,
and you're
so
in
many
London
different
a lot.
things.
Yeah.
Some of the Californian wines don't really make them over there. It's tougher to get. But really, what I look for here is to come and find some of those little nuggets. I mean, Clos Duval I hadn't seen on a list in London for a while. I found it here, and I thought, I think we can afford this as a group. So
what's like the best wine place near the office? That's what I want you to go research.
Crush, the little shop here, yeah.
That's where you go.
It used to be Sherry Lehman, but they shut the door.
They've shut the door.
Right. Okay, wow, I got that answer nice and quick. That was
exactly.
great.
Sam Fazeli, he wears a lot of hats, including the head of research for Bloomberg Intelligence in Europe. He's also a pharma analyst of some note. This is Bloomberg. All right, let's get some company news right now. Steve Rappaport.
Paul, if you can't buy them, join them. NVIDIA is reportedly in talks to invest in AI chip designer ARM. Bloomberg's Joan Doniger has more.
ARM is looking to bring NVIDIA on board as the company prepares to go public as soon as September. NVIDIA sought to acquire ARM but abandoned the plan last year after regulators challenged the deal. Sources tell the Financial Times NVIDIA and other prospective investors are still negotiating with ARM over its valuation. NVIDIA reportedly wants to come in at a share price, putting ARM's total value between $35 and $40 billion. British-based ARM wants a figure closer to $80 billion.
Thanks,
Steve?
Joan. Shares of NVIDIA currently up more than 2%. Meta Platforms intends to fight back against allegations from the EU that it stifles ad rivals by tying the Facebook marketplace to its social network. Sources tell us Meta reps will attempt to rebut the EU's claims at a closed-door hearing in Brussels tomorrow. The company insists its practices are not an illegal abuse of dominance. Shares of Meta right now currently up more than 2%. And shares of Domino's are jumping after the company announced a third-party ordering agreement with Uber. Bloomberg's Dan Schwartzman reports.
The deal will allow diners to order Domino's through the Uber Eats and Postmates apps. The company will do a test in 4 pilot markets in the fall and is expected to roll out the service across the country by the end of 2023. Uber Eats will be Domino's exclusive third-party platform in the U.S. until at least 2024. Ann Arbor, Michigan-based Domino's benefited from elevated consumer demand during the pandemic, but has struggled in recent quarters after Americans returned to in-person dining and some lower-income consumers switched to eating at home.
Thanks, Dan. This is Bloomberg.
You're listening to Bloomberg Markets with Paul Sweeney on Bloomberg Radio.
All right, Molly Smith, Paul Sweeney here in the Bloomberg Interactive Brokers studio. A solid day for the market. We are off the highs for the day, but the S&P up about 0.7%. The NASDAQ up about 0.7% as well on that. On the backs of that little bit tamer than expected inflation print here. I'm also looking at the commodity space. Another strong day for oil. WTI crude oil up 1.5%, trades at just under $76 per barrel. So that gets your attention here. We were solidly below 70, so a solid move to the upwards right now. So we'll keep an eye on that. Right now, let's head down to Washington, D.C. We'll go to Nathan Hager for World International News.
All right, Paul, thank you. Ukrainian President Vladimir Zelensky softening his tone with NATO leaders at the conclusion of their summit in Lithuania.
The outcome of the NATO summit in Vilnius is very much needed and meaningful success for Ukraine.
President Zelensky spoke after getting new security assurances from the U.S. and other G7 nations. Bloomberg's Anne-Marie Horton reports President Biden is billing this NATO summit as a success as well.
This is really part of his major foreign policy goal, not just keeping NATO united, but also the expansion of NATO. We had here Sweden joining, and then today you saw some reconciliation with Zelensky, who really took a sharp tone with NATO members yesterday on Twitter, but today he was really showing how grateful he is to NATO members and also the G7.
Bloomberg's Anne-Marie Horton reporting from the summit in Vilnius, where President Biden's going to be giving a speech in a little bit less than an hour. It's set for 12:45 Wall Street time. You'll hear that live on Bloomberg Radio. Republicans are giving the FBI and its director, Christopher Wray, a grilling on Capitol Hill. Jim Jordan chairs the House Judiciary Committee.
American speech is censored. Parents are called terrorists. Catholics are called radicals. And I haven't even talked about the spying that took place of a presidential campaign or the raiding of a former president's home.
Director Wray is defending the Bureau from Jordan's remarks.
The men and women of the FBI work tirelessly every day to protect the American people from what is really a staggering array of threats.
Now, this is the first oversight hearing for Christopher Wray and the FBI, with Republicans back in the House majority. The Emmy nominations are rolling out, and up for Best Drama this year, Succession, once again, was the big star at the Emmys last year with 25 nominations. Once again up for the big prize in its final season, along with The White Lotus, The Last of Us, House of the Dragon, and some other shows that aren't on HBO, including Better Call Saul, The Crown, Yellow Jackets, and Andor. That's 4 nods for HBO just in the drama category, which the cable network has won in 6 of the last 8 years, for those keeping score. Global news, 24 hours a day, powered by more than 2,700 journalists and analysts in over 120 countries. I'm Nathan Hager in Washington. This is Bloomberg. Paul and Madison.
All right, Nathan, thank you so much. We appreciate that. Madison Mills, Paul Sweeney here in our Bloomberg Interactive Broker studio. Wimbledon, we are moving forward towards the final weekend. We need an update here. So we have Molly Smith joining us. Her day job is she covers all the stocks and markets for Bloomberg, but really her expertise is in all things tennis. Carlos Alcaraz, I think I need to see this guy. I haven't seen him yet, but I hear amazing things about him.
Yeah, he's kind of a freak of nature, to be honest,
Right.
Paul. I mean, there's really kind of makes the rest of us, I mean, obviously we are peasants compared to him. He's, the top player in the world, but the things that he pulls off on a court are really unworldly. So he's deep in the first set right now of his quarterfinal match against Holger Rune, another 20-year-old, and he's out of Denmark. So we'll see how that one wraps up. These guys have been playing each other in the juniors for years now, so very contested one on center court.
And you're a tennis expert as well as a Federal Reserve expert.
But that's it. It's a pretty narrow focus.
That's a pretty narrow focus.
I feel like you just became the coolest person I know at Bloomberg, which is obviously, I've known that for a
You're
while.
saying this
Molly.
on air. Come on, Maddie.
We got to get it on the record. Okay, so you grew up playing tennis?
Oh, yeah. It's been, I've had a racket in my hand as long as I can think. I played in high school, played in college, played in the city. I used to teach tennis before I got a real girl job here, or a big girl job, I should say. Yeah.
All right, we're going to have you back on when we get some news on. There's a lot going on in Wimbledon. We always appreciate Molly hopping on here and give us the latest. Carlos Alcaraz, pay attention to that #1 seed. I need to check this guy out.
And
More
Chris
coming up.
Eubanks.
That's right.
American, still going strong.
This is Bloomberg Markets with Paul Sweeney.
We got a lot of green on the screen here, but the volume is light. This is a market that's much more optimistic or bullish than maybe the central bankers are. 9.5 million job openings. What are people doing? Are they just sitting in Starbucks all day?
Breaking market news and insight from Bloomberg experts.
There's still some concern out there in the market that there is room for things to deteriorate a little bit more than what they're indicating.
As small and medium-sized businesses struggle, they don't present as much competition.
What are you guys thinking about hardware, software? How should investors approach this thing called AI?
This is Bloomberg Markets with Paul Sweeney on Bloomberg Radio.
All right, coming up in this hour, we're going to check in with John Authers, senior editor for Bloomberg Opinion. He's got some opinions here on the inflation outlook and kind of what this federal bank and maybe some other central banks should do across the world. We'll check in with John. Plus, Selma Hepp, chief economist at CoreLogic, joins to discuss the latest CoreLogic Home Price Index and MBA mortgage applications. The market remains red hot. We're going to get the latest on the global energy space as well with Fernando Valle. He's the senior analyst of Bloomberg Intelligence. He covers global energy, so we'll get the latest there. But right now, let's go to Charlie Pellet. Get a Bloomberg Business Flash.
Thank you very much, Paul Sweeney. CPI Wednesday, but let us begin with crude. We've got more on the topic coming up in just a moment. We've got West Texas Intermediate now up 1.3%, closing in on $76 a barrel, $75.85 right now on WTI, up by just about $1 a barrel. But again, a 1.3% advance for WTI. Treasury yields fell after data showed a slowdown in inflation. That's bolstering speculation. The Federal Reserve is nearing the end of its interest rate increases. The 10-year, 3.85%. The 2-year, 4.72%. S&P 500 index up for a third day. Right now, the S&P is up 29 points, a gain of about 0.7%. The Dow up 159 points, higher by 0.5%. The Nasdaq Composite Index now up by 105 points. That is a gain of about 0.8%. So again, the Dow, the S&P, and Nasdaq all pushing higher. Anna Wong, the chief U.S. economist with Bloomberg Economics, says this morning's CPI data will do nothing to alter the Fed's rate hiking path.
I always compare the Fed to like a big cruise ship, and when they try to turn, they can't turn sharply. And so today we have this pretty pivotal CPI report, right? Sharp slowdown, but the Fed is not about to make a sharp turn. I think they're still on track to hike in July.
And you can hear more of that conversation on the Tape podcast. You can download it wherever you get your podcasts. Domino's Pizza shares are higher after the company announced a third-party ordering agreement with Uber. Domino's delivering a gain now of 11.2%. And Chipotle Mexican Grill is testing a robot that it hopes will slash in half just how long it takes to prepare guacamole. Chipotle shares up by 0.8%. Again, recapping, stocks are higher with the S&P up 25, a gain of 0.6%. The 2-year, 4.72%. The 10-year, 3.85%. I'm Charlie Pellet, and that is a Bloomberg Business Flash.
All right, Charlie Pellet, thank you so much. We appreciate that. Madison Mills, Paul Sweeney here in our Bloomberg Interactive Broker Studio in New York City. And also, we're streaming live on YouTube. You can go to YouTube and search Bloomberg Global News, and that's how you find the stream here. All right, we've got earnings coming up here, and I want to start really changing the focus a little bit here. Get some focus on what we might see. We got the big banks on Friday, but we got some earnings starting tomorrow. Let's bring in Bailey Lipschultz. He follows this stuff for Bloomberg Markets. Bailey, what are we having on the earnings calendar coming up?
Yeah, so tomorrow things will get interesting. We have Delta Airlines, Pepsi, and Conagra Brands, three companies that are very much obviously exposed to consumers that should give us a bit of flavor of what they're seeing. And then that'll be setting the stage for Friday when we get big banks. We get JP Morgan, we get Wells Fargo, healthcare space, we get United Health. So as much as we are all talking about inflation and the Fed, we will finally see what earnings look like and really what these companies are talking about when you look into the back half of the year. Something that investors that I've been talking to all year have been really anxious to see is once you reach that midpoint, will companies continue to talk modestly or talk whether they will talk up expectations for the rest of the year, just given all the concerns and expectations around recession expectations around the Fed.
How about that Delta Airlines? I mean, the stock's up 46% year to date. It's 52-week high, darn near its all-time high, which it reached back in 2018 of $61. It's at 48 and change here today. So this has had a big move. But I guess that leisure travel is back, and then so is the business travel is coming back, is what I understand.
Yeah, if you look at the airline group, so looking at that in particular so far this year, S&P Super Composite Airlines on your terminal, it's S15 AirL Index. That's up 38%, and really among your best performers outside of the NVIDIAs, the Metas of the world, Carnival, Royal Caribbean Cruise, those airline stocks that you mentioned, Paul. So we're going to see whether these U.S. carriers are able to continue to see strength. Obviously, I was one of the many people flying this summer, flying the last 2 weeks. So a lot of people spending a lot of money to get on these planes.
I'm not flying unless somebody pays me to fly. How about that?
That's a great rule,
That's a
Paul.
great rule. I mean, the airlines have no idea what they're doing. They're overcrowded. They don't have the capacity.
It's
They don't have the
torture.
labor.
Like, it's... Bailey is shocked. He's like, what's wrong with you guys?
It's
terrible, right?
I was just going to say, I was on an 8-hour delay last Tuesday and barely got out at 2:45 a.m. and spent an extra day in San Francisco on Sunday because of the rain. So, I am all on the avoid airlines right now.
Too. You know what I'm saying?
I do not want to travel based on my experience.
No,
last 2 weeks.
I know.
I'm
When
done.
I got a dog recently and I was like, oh no, I can't go on trips with my friends anymore. Sounds great. I don't want to do it. Also, though, this flight jet fuel demand absolutely booming, even though we are seeing those declines in CPI when it comes to airline fares hitting some of those stocks today. We're still seeing that demand staying high. Bailey, when you look at some of the consumer-facing companies that we're going to hear from in this earnings cycle, what would you say is the first that you're looking at, that your sources are looking at, that could give us an indication of consumer health this season?
I think Pepsi is going to be an interesting one because Pepsi really was at the forefront of what I would say essentially bragging about the ability to raise prices and pass that on to consumers.
Right.
So when you're looking at the company kicking off non-alcoholic beverage earnings season, expectations are that sales will be driven by price increases. That's something we've been watching. You're seeing shrinkflation. You're seeing prices being passed along to consumers and even raised, again, with people more than happy to pay up for those favored beverages, their favorite snacks, things like Frito-Lay's goods. So that's going to be interesting in my perspective. And when I talk to people, looking at what Pepsi says, how they set the stage, just given expectations that they could continue to boost expectations for the rest of the year, again, given all the things that we've been hearing about slowing inflation in terms of food.
Yeah.
All right. 222 is kind of what the S&P 500 consensus EPS is. Is there a feeling in the marketplace, Bailey, that there's some pretty good risk to that number?
I think so, but I mean, it's such an interesting market right now. When I talk to portfolio managers, you hear just as many people talking up strength and expectations that we will see a strong earnings season, and then you see the terrific story that Bloomberg had out today on Goldman talking down numbers. So you're seeing kind of this market that's so heavily driven by the Magnificent Seven, being driven by these technology companies, that people are more than happy to point out that there still looks to be growth on the horizon for a lot of these big tech stocks that make up such a large proportion of the S&P 500, of the NASDAQ 100, and continue to be the things that drive these markets higher.
All right, Bailey, thanks so much for joining us, giving us that update. Bailey Lipschultz, he covers the markets for Bloomberg News. All right, we had what the markets are interpreting as a pretty good inflation print today. Came in a little bit tamer than expected, I guess is a way to say it. And we're seeing some risk assets kind of move on the news, although stock market off its high of the day. But what does it mean going forward? John Authors has got an opinion because we pay him to have opinions. John Authors is our senior editor for Bloomberg Opinion, joining us here in our Bloomberg Interactive Broker Studio. What'd you make of this, John? I mean, it seemed pretty good to me.
Well, I would be stronger than that. I thought it was very good. And I say that having gone on record predicting that expectations for a low print were dangerously strong and that people were running for a hawkish surprise. So, you know, I can only say that I am very startled and impressed by how strong the numbers are. As the morning has gone on, the more you look at the numbers, the better from the point of view of the Fed they get. So if you break it down month by month, energy prices actually contributed positively to inflation again last month. Food inflation and goods disappeared, literally zero. And services inflation came down a lot. I mean, that's really fantastically exactly what the Fed wanted to see.
If you look at the Cleveland Fed trimmed mean, all these cunning measures of inflation we all now learn to use, over the last 3 months, it's been running at less than 2%. When you trim out the outliers on either side. So there are very few flies on this number. That it's a genuinely very encouraging number. And I guess the other thing I would say, which personally surprises me a little, I mean, you've seen, the dollar seems to have taken a decisive, which is absolutely what you'd expect from a really surprisingly good inflation report. Actual expectations for the Fed really haven't moved very much at all.
Right.
Nobody seriously still doubts that they're going to hike in July. And people are still reckoning. I mean, if you look at contracts going through to the beginning of 2025, yes, they've come down, but not even by 25 basis points from the spike last week. So it doesn't basically change. People are delighted to have this confirmed, but in terms of what they're expecting from the Fed, the notion that they will have to stay higher for longer to make sure this risk of inflation is thoroughly put to bed lives on. It hasn't changed things as much as I thought a print like this might have done.
Well, and even if we've hit peak inflation, if we're past that point, and you've written so beautifully about this, John, when does the consumer start to feel that? And when will companies, restaurants, small businesses start to decrease their prices in a way that is tangible for customers like us? That's
interesting. If you looked at the NFIB, National Federation of Independent Business numbers earlier this week, the proportion that is complaining that they're finding it hard to find people. So, obviously with restaurants, some of the waiting service I remember getting in 2020 when they reopened was almost hilariously bad. It was faulty towers. They are much less concerned about the difficulty of hiring people than they were. And their complaints about prices paid have absolutely, shot down in exactly the way that you see some of the lines on core CPI. It looks to me as though you should expect some of that to start to show through in the prices that they actually charge to people. So, I mean, politically, this is a point I think some people haven't quite taken on board, and which I haven't really taken terribly seriously because I've been a hawk thinking inflation is worse than people think it is for a while. If we're really heading for a soft landing and inflation is going to come to heel without any more pain, that would probably mean Joe Biden gets back in a landslide next year. It's very, very, very difficult to beat an incumbent who has a good an economic record as markets implicitly expect. I don't think anybody is actually braced for the Democrats to get back in a landslide. It does have, and I can't quite believe it when I say it, in the same way that I still can't quite believe that the economy is going to work out as positively as some of these numbers suggest.
You think November, or let's say months leading into November 2024, the economy is going to be total soft landing mode for Biden?
I find that hard to imagine.
That's what I'm saying.
But the implicit market forecasts at the moment are that he will get to November 2024 having slayed the inflation created by his predecessor and created all these jobs.
I mean, good luck getting Walmart to decrease the prices, though.
Well.
You know what I'm saying?
Sure, but it's one of the messages they give you at business school. Once you've finished your DCF or whatever, once you've done your spreadsheet, then look at what it implies. I did an MBA back in 2000. We valued a storage company. We reverse engineered it to try to make it worth what the market said at the time it was worth. This was 2000. And then you're supposed to work out, what does that imply? What does your valuation imply about the future? and it implied that it was going to make a return on equity of 100% in perpetuity.
In perpetuity.
And I think that's the kind of exercise that people need to do here. Like, if the market is right, then Jay Powell and Joe Biden will go down in history for one of the most brilliant pieces of economic management ever.
All right.
That's not if the market is right, which I still obviously don't believe.
Yeah.
But that's. I think that's an important thing to start thinking now. If it is the economy stupid, politics is going to be quite different over the next 18 months than people have been expecting.
All right, John, you and your colleague, Isabel Lee, out with a column yesterday, and in it you say, the Fed is staying the course on its 2% inflation target,
yes,
but wage earners will pay the price. What do you mean there?
At this point, the single biggest contributor to wage inflation, we were just discussing it to inflation overall, as we were just discussing, is services, and services businesses obviously are, absolutely preponderantly about wage raises.
Yep.
I think if you look at what Fed governors and most controversially the Bank of England back home have been saying, they've been very careful to say companies need to take tighter profit margins and workers need to accept sub-inflation pay rises, which both of them in isolation will help inflation come down. Whether they're sacrifices that are worth it are another matter. But at this point, wage inflation, it's what another positive point if you're a strategist for Biden is that real wages are now increasing very nicely.
Right.
Thanks to this sudden drop in CPI. That is good for everybody apart from those at the Fed who are particularly concerned to get inflation down. So that becomes a critical issue, and we still need to see whether the kind of expectations that have been jolted by 2 years of very real inflation that really does affect people's lives, whether that is going to create the kind of extra motivation to push for higher wages. I expect Bloomberg to pay me well. There's nothing wrong with people asking for more money. They've got families to look after, etc., etc. But the key point is, if our baseline expectations, our psychology is now that inflation is something we need to worry about, that we need to protect against, does that mean that there will be a bigger baseline, and if the Fed is worried about that, which I think they are, that implies being nastier than you would hope.
All right, John, thank you so much. We appreciate it. John Author, senior editor for Bloomberg Opinion. And somehow he's a diehard Red Sox fan. I don't get it because his accent is unique, but it is not a Boston accent.
It's not unique.
We'll have to say that for another day. This is Bloomberg. Let's get some company news right now with Mr. Rappaport.
Paul, Britain's antitrust regulator says Microsoft's proposed merger with Activision Blizzard may need a new review if the two restructure the deal. Microsoft was headed to an appeal trial after the Competition Markets Authority blocked the acquisition. Tom Smith is the former legal director of the CMA.
We're currently in a bit of a limbo stage where we have an interim order in place which forbids the closing of the deal, but the CMA has agreed to talk, and that's all they've done at this point. They've agreed to talk. It would have looked pretty bad if they had refused to talk to Microsoft.
Smith on Bloomberg Television suggested a partial divestment as a possible remedy. Disney is mulling options for its TV business in India. More from Bloomberg's Denise Pellegrini.
This potential pullback by Disney from Disney Star comes as company faces intensifying competition from local rivals in India. Sources tell us Disney recently lost the right to stream a popular cricket match, and what's being considered by Disney right now is either an outright sale of the Disney Star unit or maybe setting up a joint venture with partners there. Sources also say Disney is hoping to retain control over its content business in India, and we're also hearing that one of the companies that has been approached about a tie-up with Disney Star is Mukesh Ambani's Reliance Industries. Denise Pellegrini, Bloomberg Radio.
Thanks, Denise. Shares of Disney currently up less than 0.5%. Paul, did you get your Prime fix yesterday?
Absolutely.
All right, so you bought something.
Sure, who didn't?
Well, you are one of the consumers who ended up spending a collective $6.4 billion in the first 24 hours of Amazon's Prime Day sale. That's according to an estimate from Adobe. Adobe had predicted it was going to be 9.5% up. I'm Steve Rappaport. This is Bloomberg.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
It's 12:21 on Wall Street. We do check markets all day long at Bloomberg. Stocks are higher. Treasury yields are falling after data showing a slowdown in inflation, bolstered speculation that the Federal Reserve is nearing the end of its interest rate increases. The 2-year, 4.73%, with the 10-year now at 3.85%. Stocks well off session highs, but still the Dow, the S&P, NASDAQ all pushing higher. S&P up 27, a gain of 0.6%. The Dow up 114, up 0.3. NASDAQ up 105. That is a gain of 0.8%. Spot gold up $24 the ounce to $19.56, a gain of 1.3%. West Texas Intermediate crude up by 1% now, $75.57 for a barrel of WTI. Britain's antitrust watchdog says a new merger investigation into Microsoft's $69 billion Activision Blizzard deal may be needed if the duo restructure their deal in a bid to reverse a UK veto. Microsoft shares, they continue to push higher, up 1.3%. Activision Blizzard today down 1.4%. Again, recapping, stocks are higher. S&P now up 27, a gain of 0.6%. I'm Charlie Pelleton. That is a Bloomberg Business Flash.
Charlie Pello, thank you so much. We appreciate that. Madison Mills and Paul Sweeney here in the Bloomberg Interactive Brokers studio. I'm looking at the Bankrate.com U.S. home mortgage 30-year fixed national average, 7.32%.
Wow.
It reached a low of sub 3% back in early 2021. So what a move. I think Matt Miller scored his mortgage then, so good for him. He's always targeting this market. So just an amazing move higher. What does that mean for the housing market, residential housing market? Well, Selma Hepp's going to help us there. Selma is chief economist for CoreLogic, and she joins us here. Selma, I see that big leap in mortgage rates. What's that doing to the residential real estate market in the U.S.?
Well, it's definitely putting a significant damper on home sales activity. Home sales activity did start off on a pretty good note earlier this year. We talked about that a few months back, and since mortgage rates started increasing back to 7%, we've seen significant slowing in home sales activity. So at this point, we're looking at about 30% lower total year-to-date number of home sales than we did at this time in totality for 2022.
And when you look at the housing market in particular, I'm looking at some data from our friends over at Bloomberg Intelligence, which Paul knows very well. Housing becoming so unaffordable that over 75% of homes on the market are too expensive for middle-income buyers. What do you make of that in terms of the impact that's going to have over the course of the rest of the year?
Well, I think really that is the biggest problem. Affordability is a huge problem. And we had this problem even going into the pandemic, but now with home prices up 40% higher than they were at the onset of the pandemic, typical mortgage payment is now at the highest level on record. And so a lot of folks are spending significant portion of their household income on mortgage payment. And it's up to about 36% of households' median income being spent on a mortgage payment. I mean, this is really huge. And this is in terms of historically looking at lowest level of affordability, we're at the lowest we've been in almost 40 years now.
Wow. So how does this historically play out? Do you just have to wait for interest rates to come down? How does this work in the housing market? Do you see home builders, giving breaks on maybe buying down some of the mortgage payment for buyers? How does this work?
Right. Yeah. On one hand, home prices are playing a role. The other contributor is income growth. So many times you need income growth to catch up to that home price appreciation. And so at this point, unfortunately, we're seeing home prices reigniting again. They're gaining speed again. And in looking at our most recent home price index, that was just released a couple of days ago. It showed that in the first 4 months of this year, or basically from February to May, home prices are up over 4% cumulatively. I mean, that's almost as much as we see in an entire year. So we are now seeing home prices just really gaining speed again, meaning that affordability is going to be further declining and further constraining people's ability to buy a home. So, you mentioned what can we do? One, again, is rise in home price in households' incomes. The other one is adjustment in home prices. And while overall, I was talking about nationally, we might see in some, particularly in some smaller markets where you don't have a lot of folks moving in with higher incomes. We talk a lot about out-migration from more expensive coastal areas where people have a lot of income to more affordable areas. That's what's been driving home prices in many of those areas. But when you look at smaller markets, that level of home price appreciation is not sustainable. So we'll definitely see a more significant slowdown and even potentially some declines in those smaller markets.
All right, so I got to ask my favorite question. How is this playing through to the rental market? What is that looking like?
Yeah, well, rental market is slowing too in terms of home price or in terms of rent prices. We do have a single family rent index that we report on every month, and the rate of growth has continued to slow considerably from where it was last year. I mean, it's very much in line with what's happening with home prices. But on both home prices and rents, what's interesting is that the lower price tiers are actually continuing to see stronger gains than higher price tiers. It's higher price tiers that have slowed down more considerably since people started going back to the offices, and sort of that pressure in these amenities markets has slowed. But the lower, the types of homes that are in need, where people are not doing it out of luxury, right? Those are the prices and rents where we do see continued pressure.
Selma, how about in terms of new home construction? Where are we in building new homes, and what kind of homes are getting built? Because it seems like, as we talk about the affordability issue, the average town in America doesn't need another McMansion. What they need is, more affordable kind of single-family homes. Is that being built?
Well, yeah, we do see, we're seeing overall an increase in home building activity. Unfortunately, it is skewed towards more multifamily type housing, but nevertheless, it's adding to the housing inventory. At this point, I mean, we just need overall more inventory, any type of inventory that we can get. But we are seeing an increase in single family as well, and we are seeing a tilt towards smaller size home, which are generally priced more favorably. So, I think builders are moving in that direction. They are responding to market needs at the moment, and particularly given how much affordability has been constrained at this point with higher mortgage rates.
So is more inventory good regardless of what that inventory looks like right now?
I think so. I mean, when you look at the, CPI, when you look at where Fed is thinking about going, housing component is a huge component of our inflation measure, right? 30% is housing, and a lot of that comes from rents. Rents and household owners equivalent rent, so the home ownership type component, but in both of those, we do need less increases. So in contrast to where we're currently seeing in the housing market. So with more inventory out there, whether that's high density multifamily housing or single family housing, I think all of those will help slow inflation or lead to deceleration of that inflation, which will help with Federal Reserve's action and hopefully bring mortgage rates lower, which again, that in the end helps with affordability.
All right, so Selma, at CoreLogic, what are you guys forecasting for mortgage rates going forward?
Well, unfortunately, mortgage rates forecasts have gone up, particularly given what we just saw today with mortgage rates going over 7%. So at this point, I think we're more declining, but not declining as much as we hoped, to less than 6%. I think we're now looking at slightly over 6% mortgage rates by the end of this year.
Okay, so what should someone who wants to buy a home eventually be thinking right now? Should they be holding off for a long time, or is it just that they always get more expensive? So if you're going to do it, you might as well do it now.
Well, the truth is, yeah, historically, when you look at home prices in the U.S., they have been going up pretty steadily, you know, if you take out the Great Recession period. But, you know, one action that people have been relying on is locking in a mortgage right now, buying a home right now, because there's much less competition out there, and then hoping to refi down the road. So, you know, I think that is not a bad way to go about it, especially that given that inventory is a concern and it's going to remain a concern. I mean, it will take few years, more than a handful of years for us to catch up if we continue to build at the rate that we're building right now, for inventory to sort of balance with the demand. So, you know, whenever we have mortgage rates coming down and all the folks that didn't buy during the pandemic, and there is a lot of them because there is this huge millennial group that is coming of first-time home buying age, competition intensifies, and that leads to more bidding wars, that leads to home selling over the asking price and superior home price appreciation. So I think now, given that it's not as competitive in the market, is not a bad time.
All right, Selma, thank you so much for joining us yet again. Selma Hepp, Chief Economist for CoreLogic. Right now, let's head down to Washington, D.C. We'll get world and national news with Nathan Hinker.
Okay, Paul, we're waiting for a major speech from President Biden at the end of the NATO summit in Lithuania. It's about to start in the next couple of minutes or so. He's already billing this meeting, though, as a success after sitting down today with Ukrainian President Volodymyr Zelensky.
I hope we finally have put to bed the notion about whether or not Ukraine is welcome in NATO. It's going to happen. You're all moving in the right direction. I think it's just a matter of getting by the next few months here.
President Biden spoke after offering new security guarantees for Ukraine along with other G7 nations. Bloomberg's Maria Tadeo reports Zelensky is changing his tone as well after demanding a timeline to join NATO.
But now you see a Zelensky who says this was a good package for Ukraine. An invitation would have been the optimal outcome when it comes to the political signal. But the country walks away with a G7 commitment, with funding, with training. And again, this political declaration that they cannot join now. The conditions are not there, but the future of Ukraine is in NATO.
Bloomberg's Maria Tadeo covering the NATO summit in Vilnius. Again, we're expecting President Biden's remarks in about 10 minutes or so, 12:45 Wall Street time. You'll hear them live here on Bloomberg Radio. FBI Director Christopher Wray says his agents will comply with a federal judge's order barring communication with social media companies. He says the Bureau's efforts, though, are intended to counter online misinformation from foreign adversaries.
Today's FBI leaders reflect the best of our organization, an organization that is made up of 38,000 men and women who are patriots, professionals, and dedicated public servants. And that is the real FBI.
Director Wray spoke at a House Oversight Committee hearing where Republicans have been accusing him and the Bureau of being politicized. It's the first oversight hearing for the FBI under a Republican majority in the House. Global news 24 hours a day, powered by more than 2,700 journalists and analysts in over 120 countries. I'm Nathan Hager. This is Bloomberg.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
It's 12:40 on Wall Street. We do check markets all day long at Bloomberg. We have got the Dow, the S&P, and NASDAQ all advancing. We're off session highs, but still a 33-point gain now for the S&P 500 index. That is an advance of 0.8%. Stocks rose, Treasury yields fell after data showing a slowdown in inflation bolstered speculation that the Federal Reserve is nearing the end of its interest rate hikes. S&P up for a third day. The Dow up 149 points, now up by 0.4%. NASDAQ up 134 points. That is a gain of 1%. We've got the 10-year yielding 3.85%. Two-year yields, which are more sensitive to imminent policy moves, have tumbled below 4.75%, 4.72% right now on the two-year. Spot gold is up $26 the ounce to $19.58, a gain now of 1.4%, while West Texas Intermediate crude up another 61 cents a barrel to $75.45, up 0.8%. Big banks kick off earnings on Friday. A lot of investors are anxious the upcoming reporting season will put a dent in the recent stock rally. Michael Darda is chief economist and market strategist at Roth MKM.
If top-line growth is weakening or especially contracting relative to slower-moving cost variables on the wage side, that is a setup for a margin squeeze. So I think we're going to have difficulty going forward. And then we have to ask ourselves, why is this equity market performing the way it is? Is it simply pricing in a huge turnaround in earnings, or do the forward indicators tell you that there's no there there? And then eventually, I think we're looking at lower equity prices.
And you can hear more of that conversation with Michael Darda on the Bloomberg Surveillance podcast. You can download it wherever you get your podcasts. Bank stocks, meanwhile, are advancing ahead of earnings. J.P. Morgan Chase up 0.9%. Citigroup up now by 2.9%. Wells Fargo up by 1.2%. And of course, tomorrow morning before the open, we will be hearing from Delta Airlines. Again, recapping, we do have stocks moving higher. S&P up 33 right now, up by about 0.7%. Two-year 4.72%, with the 10-year 3.84%. I'm Charlie Pellet. That is a Bloomberg Business Flash.
Charlie Bell, thank you so much. We appreciate that. Madison Mills and Paul Sweeney here in the Bloomberg Interactive Broker Studio. Looking at WTI crude oil, again, another big move up here, 0.8%, over $75 a barrel. We had been under 70, so a nice little move off of the bottom there for the bulls. Let's check in and see where this thing is going to go, how you play it, what the companies are saying. Fernando Valle, he is the senior analyst for Bloomberg Intelligence, covering all things on the global energy front, joining us via Zoom here. So, Fernando, what do you make of this move higher in crude oil? And then how does that trickle down to the rest of the energy space?
Well, I guess the recession's over, and we're safe and sound, and it was a soft landing. Well, jokes aside, I think that is one of the main drivers, is that there is hope that we are going to get that soft landing, and that the Fed, as inflation cools, is going to move away from raising rates, and then ultimately impacting consumption and the overall demand for oil and energy in general. We don't think we're quite there yet for a few reasons. If you look at just credit card data, if you look even at the inventory numbers that came out from the U.S. today, really poor numbers, big build in both crude and especially in diesel, and a disappointment in gasoline. We aren't seeing the consumption data backing up this view that recession and fears are over.
What is the outlook for gas prices when it comes to the consumer picture? And to what extent do you anticipate gas prices remaining a little bit cooled as we get closer and closer to that 2024 election date?
Well, I mean, cool is very relative right now, considering it's still, for us over $3.40 a gallon. But
yeah.
With oil prices, oil has an outsized impact on the actual price that we pay. It is the biggest component. It's as much as 60% of what we pay at the pump. So this move, as Paul mentioned, going from under 70 to 75, will have a direct impact raising the cost to consumers. And that's relevant as well for the inflation picture. Remember, energy is a big component, not just at the pump, but also it impacts industrial usage. All of our transportation, heavy transportation, relies on diesel. So that will ultimately put the brakes on this cooling inflation if we continue to move higher, which again, we don't think it's the case. We think we're probably going to be capped around this level, and it could see some pressure if our call on consumer demand slowing comes to fruition.
Fernando, what are the companies that you cover, the big companies like Chevron and Exxon, what do they kind of tell you guys, the analysts and the investors, about where they think the price of oil is going short term and longer term? Do they ever come out in the marketplace and say, hey, this is kind of what we're modeling?
Well, they don't. Okay. They will put a long-term price forecast in their annual reports, but they, frankly, they don't usually change much, and it's anywhere between $70 to $90 a barrel, and it has been whether oil is 130 or 60. The mentality, especially on the U.S. side, is we're going to win whatever the case may be. And they've reduced costs significantly since the pandemic. And I think right now they're at a very sustainable level. Leverage is under 0.5 times EBITDA, even at a lower EBITDA in 2023 than 2022. They are generating enough free cash flow to cover dividends and, in a lot of cases, very aggressive buybacks. So they can withstand oil at $70, $75. That's not a problem for them. They really have moved the cost scales down to the 40s, to the mid 40s, really, to cover their dividends. So they're sitting pretty right here, making excess cash flow.
So when you look at a day like today, when the entire energy sector is in the green, I'm just taking a look and seeing that there are only 3 names struggling in the red here today, and one of the decliners there is Valero Energy. What is a Valero doing that's driving them down today in comparison with all the green that we're seeing on the screen?
Well, Valero paradoxically is investing in renewable diesel, which has its challenges right now. They are one of the largest producers of renewable diesel, and that is partially why they're down. The second portion of it is Gulf Coast margins have actually been the weakest out of all the regions in the U.S. for the refiners. So that is why they're struggling a little bit. I think when you look at Valero in the long scheme of things, they are very diversified and very well positioned as far as their refining footprint. So they tend to be winners because they're at the low end of the cost scale. And I think for any commodity business, being the lowest variable cost is ultimately how you generate the excess free cash flow that we're talking about with the majors and E&Ps now. And refiners can get there as well by cleaning up their cost curve and making sure they're the lower end of the global cost curve, and they're very competitive on a variable cost. I think U.S. refiners will be competitive for a long time because we are the largest oil producer and we have very low natural gas prices. That lends us a considerable advantage against Europe or even Asia.
So let me ask about the Strategic Petroleum Reserve, the SPR. What's going on there? Are we refilling that thing?
Slowly. So they're mandatory sales that ultimately bring us down, and then DOE has done a few auctions to refill. Don't expect us to refill at the same pace that we sold barrels in 2022. We sold 220 million barrels, very expressive sale. If we did that in a year, you would have an outsized impact on oil prices. So expect that to be gradual, slowly but surely, maybe a few million barrels every month. And, as alarming as it sounds to sell a significant portion of your SPR, we are now the largest oil producer in the world. That wasn't the case in 2010. So we don't need as big a buffer because we can produce a lot of that energy here. We produce 12 million barrels a day. So 220 million is only a few days of that production.
Why is America not in OPEC?
Well, because for one, we can't do anti-competitive agreements like a cartel. So
really, is that
antitrust laws will prevent us from being in OPEC?
I didn't know that. That makes sense. All right, so are our shale guys? Where are they cranking it out here? Are they producing, pumping, whatever a fracker does?
I think at the best of their ability. We talked about this a while back. They saw a lot of cost inflation as well. Labor is tight. Other inputs are also very tight. So they can't keep growing to the detriment of their own profits, and they won't. It's not their responsibility to their shareholders is to be profitable, and so they won't. And there is limitations as well on the acreage. The acreage today, the available acreage is not as good as it was in 2017, 2018, because we tend to drill our best wells first.
Right.
And so it may need a little bit more technological breakthrough. And the good news is we're always innovating, and there's a lot of investments now in trying to obtain more oil from the same location.
Yep.
And we're confident that in the next 10 to 15 years, we'll have some significant breakthroughs in that region.
All right, Fernando, great stuff as always. Fernando Valley, senior analyst covering the energy space for Bloomberg Intelligence. We're waiting for President Biden to deliver some comments at the conclusion of this NATO summer summit in Lithuania. So when he comes on stage, and we will go to that. But first, we want to just kind of preview what we might hear here from the president from this summit. We check in with Ryan Teague Beckwith. He is a White House and political reporter for Bloomberg News down in D.C. We have President Biden. So let's go right now to Lithuania for the NATO summit. And here's President Biden.
God love you. No seats. Holy mackerel. It's good to be back in Vilnius, a nation and a region that knows better than anyone the transformational power of freedom. You know, we showed the world that the strength of a people united cannot be denied. And together, with your brothers and sisters in Estonia and Latvia, you helped end the era of division through the power of connection. The Baltic Way, not the Berlin Wall, became the symbol for Europe's future. And later, when the Soviet tanks sought once more to deny your independence, the people of Vilnius said no, 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 no. And in January of 1991, tens of thousands of citizens, unarmed and unyielding, came for their own accord, standing as one to protect the TV tower, to shield the Supreme Council, and defend freedom. 14 heroes tragically lost their lives. Hundreds were wounded. But the whole world saw that decades of oppression had done nothing to dim the flame of liberty in this country. I mean it. It's consequential. The light of Lithuania, you kept it strong, you kept it bright, and you kept the light shining. Here in Vilnius and in Washington, D.C., where the yellow, green, and red of your flag flew every day, this past year, we've celebrated 100 years of unbroken diplomatic relationship between the United States and the Baltic states. America never recognized the Soviet occupation of the Baltics. Never, 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 Mr. President. And besides, you got a great president. Stand up. No, stand up. As your president can tell you, the bonds between Lithuania and the American people have never faltered. And just 7 months after the bloody January crackdown, the first foreign visitor to have their passport stamped here in Lithuania with visas to this new reborn state were a plane load of Lithuanian Americans from Chicago, Illinois. Oh. And their families are still proud of that. Los Angeles came after that. A lot came after. Look, many aboard that plane and fled Lithuania during the early years of Soviet oppression and marveled at their return to this independent state. One of them told reporters, quote, "This day is like a resurrection for us. This day, Father, is like a resurrection for us." That's what the quote was, for real. That's the feeling. And it was. A resurrection that quickly became a revelation. And a nation which stands today as a stronghold of liberty and opportunity. A proud member of the European Union and of NATO. I had the great honor as United States Senator of championing Lithuania and other Baltic states to join NATO in 2004. Wasn't I brilliant doing that? But all kidding aside, think about how it's changed things. Think about what's happened. Now, over the last few days, as President of the United States, I had the honor of participating in the historic NATO summit hosted by Lithuania, where we welcomed NATO's newest ally, Finland, and reached agreement to bring Sweden into the alliance as soon as possible. And President Erdogan kept his word. We've witnessed your historic journey, and I'm proud to call Lithuania friend, partner, and ally. Ally, ally. Soon NATO will be the 32nd freestanding, have 32 freestanding members standing together to defend our people and our territory. Beyond all the rest, bound by democratic values to make us strong, and by our sacred oath that an attack against, it is a sacred oath. Attack against one is an attack against all, because each member of NATO knows that the strength of our people and the power of our unity cannot be denied. If I sound optimistic, it's because I am. Today, our alliance remains a bulwark of global security and stability, as it's been for more than 7 decades. NATO is stronger, more energized, and yes, more united than ever in its history. Indeed, more vital to our shared future. It didn't happen by accident. It wasn't inevitable. When Putin and his craven lust for land and power unleashed his brutal war on Ukraine, he was betting NATO would break apart. He was betting NATO would break. He thought our unity would shatter at the first testing. He thought democratic leaders would be weak, but he thought wrong. Faced with the threat, the peace and stability of the world, to democratic values we hold dear, to freedom itself, we did what we always do. The United States stepped up, NATO stepped up, our partners in Europe and then the Indo-Pacific stepped up. All across the world, they stepped up. And we're ready. We were ready because we stood together. In the months leading up to the war, as Putin amassed his forces on the Ukrainian border and laid the groundwork for his brutal invasion, I was in constant contact with my fellow leaders of the G7 and the European Union and NATO, constantly. We warned the world what Putin was planning. Even some in Ukraine didn't believe what we had our intelligence community found. We made sure NATO was prepared to deter any aggression against any member state. We pursued intense diplomacy with Russia, seeking to avert this terrible war. And when Russian bombs began to fall, we did not hesitate to act. We rallied the world to support the brave people of Ukraine as they defend their liberty and their sovereignty with incredible dignity. I mean that from the bottom of my heart. Think about it. Think about what they're doing. After nearly a year and a half of Russia's forces committing terrible atrocities, including crimes against humanity, the people of Ukraine remain unbroken. Unbroken. Ukraine remains independent. It remains free. And the United States has built a coalition of more than 50 nations to make sure Ukraine defends itself both now and is able to do it in the future as well. Since this war began, I've stood with President Zelensky, as I just spent about an hour with him, both in Washington, in Kyiv, in Hiroshima, and now in Vilnius, to declare to the world what I say again: we will not waver. We will not waver. I mean that. Our commitment to Ukraine will not weaken. We will stand for liberty and freedom today, tomorrow, and for as long as it takes. We all want this war to end on just terms. Terms that uphold the basic principles of the United Nations Charter that we all signed up to: sovereignty, territorial integrity, These are two pillars of peaceful relations among nations. One country cannot be allowed to seize its neighbor's territory by force. Russia could end this war tomorrow by withdrawing its forces from Ukraine, wrecking its international borders, and ceasing its attacks on its inhumane attacks on Russia. By Russia on Ukraine, against its children, women and children, its military. Unfortunately, Russia has shown thus far no interest in the diplomatic outcome. Putin still wrongly believes that he can outlast Ukraine. He can't believe it's their land, their country, and their future. And even after all this time, Putin still doubts our staying power. He's still making a bad bet that the conviction and the unity among the United States and our allies and partners will break down. He still doesn't understand that our commitment, our values, our freedom is something he can never, never, ever, ever walk away from. It's who we are. I mean, it's who we are. It's who we are. Throughout this horrific war, the people of Lithuania, together with our Baltic brethren, have been among the most fierce champions of Ukraine's right to a future of its own choosing, one that is free, because you lived so long with freedom denied. Many of you who are older know better than anyone how precious the right to determine your own future is. Precious to people everywhere, not just in Ukraine, but Belarus, Moldova, Georgia, and all the places around the world where people continue to fight to make their voices heard. So my message to all of you tonight is keep it up, keep it going. Keep reminding the world of hope that Lithuania embodies, and that's what you embody, hope in this country. Oh, I really mean it. I'm not joking. I mean this sincerely. We must never forget how much this matters, and never, never give up on a better tomorrow. The defense of freedom is not the work of a day or a year. It's the calling of our lifetime, of all time. We are steeled for the struggle ahead. Our unity will not falter, I promise you. Folks, as I look around the world today at a moment of war and peril, a moment of competition and uncertainty, I also see a moment of unprecedented opportunity. Unprecedented opportunity. Opportunity to make real strides toward a world of greater peace and greater prosperity, liberty and dignity, equal justice under the law, human rights and fundamental freedoms, which are the blessing and birthright of all of humanity. That is the world the United States is working toward. And it's one we'll only reach if we do it together. And I mean together. We need to take the same spirit of unity, common purpose, determination that we have demonstrated in our response to Russian aggression in Ukraine, and bring more partners along as we continue working to build a world we want to live in and a world we want for our children. My friends, at the most fundamental level, we face a choice. It's not hyperbole. We face a choice. A choice between a world defined by coercion and exploitation, where might makes right, or a world where we recognize that our own success is bound to the success of others. When others do better, we do better as well. Where we understand that the challenges we face today, from the existential threat of climate change to building a global economy where no one gets left behind, are too great for any one nation to solve on their own. And that, to achieve our goals and meet the challenges of this age, we have to work together. And I mean this sincerely. The world's changing. We have a chance to change the dynamic. That's why I've been so focused as president on rebuilding and revitalizing the alliances that are the cornerstone of American leadership in the world. These past years, we brought the transatlantic partnership to new heights, reaffirming the importance of the relationship between Europe and the United States as an anchor to global stability. The idea that the United States could prosper without a secure Europe is not reasonable. We've also elevated it. It really isn't. Not a joke. We're also elevating and deepening American alliance in the Indo-Pacific with Japan, the Republic of Korea, Australia, the Philippines, which provide critical security and deterrence in that vital region of the world. Through our Quad partnership, it's a fancy way of saying our partnership with Australia, India, Japan, and the United States, we're bringing major democracies of the region together to cooperate, keeping the Indo-Pacific free and open, prosperous, and secure. We've demonstrated during this NATO summit with Indo-Pacific partners joining us for the second year in a row. We're working to deepen connections between the Atlantic and Pacific democracies so that we can better work together toward the shared values we all seek. Strong alliances, versatile partnerships, common purpose, collective action to meet our shared challenges. The world has shrunk. That's how we build a future to see when we share and know we share challenges and work together. We have to step up together, building the broadest and deepest coalition to strengthen and defend the basic rules of the road, to preserve all the extraordinary benefits that stem from the international system grounded in the rule of law. We have to come together to protect rights and freedoms, to underwrite the flow of ideas and commerce, and which have enabled decades of global growth. Yes, territorial integrity and sovereignty, but also principles like freedom of navigation and overflight, keeping our shared seas and skies open so that every nation has equal access to our global common space. And as we continue to explore this age of new possibilities, an age enabled by rapid advances in innovation, we have to stand together to ensure that the common spaces of our future reflect our highest aspirations for ourselves and for others. As my dad would say, that everybody is treated with some dignity. So that artificial intelligence, engineering, biology, and other engineering emerging technologies are not made into weapons of oppression, but rather used as tools of opportunity. Working with our allies and partners to build a supply chains that are more resilient, more secure, so we never again face a situation like we had during the pandemic, where we couldn't get critical goods we needed for our daily lives. You know, we all must summon the common will to actually address the existential threat of accelerating climate change. It's real. It's serious. We don't have a lot of time. It is the single greatest threat to humanity. It's only by working together that will prevent the worst consequences of climate change from ravaging our future and that of our children and grandchildren. We also have to recognize our shared responsibility to help unlock the enormous potential that exists in low and middle income companies around the world, not out of charity, but because it's in our own self-interest. We all benefit when more partners stand together working towards shared goals. We all benefit when people are healthier and more prosperous. And that's not, again, hyperbole, it's true. We all benefit when more entrepreneurs and innovators are able to pursue their dreams for a better tomorrow. You know, so we need to update our tool set to better address the needs of today in this interconnected world. A world where climate disasters, pandemics, conflicts, spill over borders, make it harder to address the challenges of poverty and instability that hold so many people back. That's why the United States is leading an effort to transform the multilateral development banks, like the World Bank, help them better address the global challenges while enhancing their core mission of reducing poverty and boost shared prosperity. We're all working together with our partners in the G7 to address the enormous needs for high standard infrastructure around the world, especially in low and middle income countries in Africa, Latin America, and Southeast Asia. It's a statement about the world we want to build together. Ladies and gentlemen, we stand at an inflection point in history, where the choices we make now are going to shape the direction of our world for decades to come. The world has changed. Will we turn back naked, unchecked aggression today to deter other world would-be aggressors tomorrow? Will we staunch the climate crisis before it's too late? Will we harness the new technologies to advance freedom or will we diminish it? Will we advance opportunity in more places or allow instability and inequality to persist? How we answer these essential questions is literally going to determine the kind of future our children and grandchildren have. And again, that's not an exaggeration. It's a fact. It's going to take all of us. All of us. I believe that with ambition, with confidence in ourselves and one another, with nations working together for common cause, we can answer these questions. We can ensure the vision we share and the freedoms we cherish are not just empty words in a troubled time, but a roadmap. I mean this literally, a roadmap, a plan of urgent action toward a future we can reach if we work together. Folks, the road that lies before us is hard. It will challenge us, summon the best of ourselves, to hold faith in one another, and never give up, never lose hope, never. Every day we have to make the choice. Every day we must summon the strength to stand for what is right, to stand for what is true, to stand for freedom, to stand together. That, my friends, is the lesson we learn from history and the history of Lithuania's story. You know, it's a lesson we see demonstrated each day, and it will determine what the Ukraine looks like. And it's how we're going to work, how we rewrite the future, the peace and hope, justice and light, liberty, possibilities for everyone, everywhere. Folks, some have heard me say to my country many times, never, ever in my entire career been more optimistic about the prospects of the future. Never. So let me just say thank you for taking the time to be here to listen. God bless you all, and may God protect the freedoms of the protectors of freedom in Ukraine, here, in every nation in the world, everywhere. God protect our troops. Thank you.
President Joe Biden speaking live in Vilnius, Lithuania, wrapping a two-day NATO summit with a bit of a victory lap, as you just heard, after securing the admission of Sweden to the alliance, the exact thing that Vladimir Putin did not want to see.
He was betting NATO would break. He thought our unity would shatter at the first testing. He thought democratic leaders would be weak, but he thought wrong. Faced with the threat,
as the president now heads to Finland for a summit of Nordic nations, we seek perspective here on Bloomberg Sound On. I'm Joe Matthew in Washington, and we thank you for joining us in conversation now with a real authority. Kurt Volker, the former U.S. ambassador to NATO, who also worked as U.S. Special Representative for Ukraine negotiations, is back with us right now on Bloomberg. Mr. Ambassador, we welcome you back. Was this NATO summit the success that President Biden just made it out to be?
There were some successes, but I don't think it did everything that it needed to do. I think getting Sweden through, the Turks relenting on their opposition to that, and therefore bringing all of Northern Europe, Finland and Sweden, under the alliance umbrella, that's a very good thing. That's going to strengthen alliance security. On Ukraine, however, I think that we didn't do as much as we could have done. We gave very vague language about Ukraine becoming a member in the future without any clear commitment to that, any new resolve behind that. And I think Putin's going to look at that as a hesitation on NATO's part.
Vladimir Putin, watching all of this from Moscow, is thinking what?
Well, I think he's thinking that he should keep fighting in Ukraine. If he had gotten a signal that was stronger, that we are going to make sure that Ukraine wins, use the word victory, use the word winning, and that they are going to be a member of NATO, make no mistake about it, this is going to happen. I think it would send a signal to Putin that he's not going to succeed at this. No matter how much he fights, it's just not going to work. But instead, by more hesitant language, I think it encourages Putin to think he can still outlast the West. There's not a real commitment there. If he just keeps going, he can get more territory, more land, force a negotiation for Ukraine to give up things to Russia. So I think he's encouraged.
That's discouraging, I'm sure, for many to hear. And I'd like to ask you a little bit more about the change of tone that we heard from President Zelensky on this idea of Ukraine eventually joining NATO. Here he is from earlier today.
Ukrainian delegation is bringing home significant security victory for the Ukraine, for our country, for our people, for our children. It opens for us absolutely new security opportunities. And I thank everyone who made it possible. Thank you, dear colleagues. Thanks you. Thanks, Lithuania and Jens Stoltenberg. Thank you very much. Slava Ukraini.
Mr. Ambassador, that is a far cry from what we heard yesterday as President Zelensky tweeted that uncertainty is the problem here and, in fact, a greater risk than joining NATO. Who got to President Zelensky overnight?
Yeah, I think that people probably did counsel him that it's not in his own interest to be, what would you say, biting the hand that feeds you. He's dependent upon the U.S. and all of these other countries that are helping Ukraine. Don't just go after them and criticize. Try to make the best out of this. And I think also a recognition, emotionally he responded one way, but over time, as you think about it, there is no other way that this works out in the end. Ukraine will become a member of NATO someday, and also a member of the EU. It's just that it's not as clear today and not as much commitment today as he wanted, but it's still going to end up going the same direction.
Well, if you were still U.S. ambassador to NATO, what would have been your advice to President Biden? What should have been the language used to not essentially motivate Vladimir Putin?
Right. I think we say that we will, we are determined to admit Ukraine to NATO as soon as it is practical to do so. Clearly, no one's going to do it while the fighting is going on because we don't want NATO to join the war against Russia. But we also need to say that we will do this as soon as possible, which is much stronger than what we came up with. There's a sentence in the NATO communique which says that Ukraine will receive an invitation at the time when all allies agree and when conditions are met. And what that tells you is that allies don't agree now, and it tells you that there are conditions that are not met. Well, that is the wrong signal to send. I think it needs to be, we will bring them in as soon as possible. We've made that decision. The train is leaving the station. As soon as it's practical, we will act. That would have been a stronger signal.
Here's how Joe Biden framed it in the last 24 hours.
I hope we finally have put to bed the notion about whether or not Ukraine is welcome in NATO. It's going to happen. You're all moving in the right direction. I think it's just a matter of getting by the next few months here.
Just a matter of getting by the next few months. Does he think the war is over in the next few months?
That's what it sounds like from what he said there. And
that'd be a heck of a development.
I hope that that's true. I hope that that's the case. And I hope, therefore, we give them what they're asking for, the long-range artillery systems, fighter aircraft, help them get it over with in a few months. And I think maybe that statement by President Biden was actually trying to compensate for some of the weak language that the NATO communique put out.
How about that? I want to ask you about Turkey, but just before we get there, the idea of peace in Ukraine, I don't want to be ironic here or disrespectful, but we haven't talked about this in a long time. And whenever it comes up in the White House briefing room, it said, well, nothing for Ukraine without Ukraine. They will do this on their time. But at what point, Ambassador, does the U.S. have to start pushing this idea?
Well, I think it's always tempting. Everybody wants there to be peace. Everybody wants a negotiation. But we want that, yet Putin doesn't. Putin can, as Biden said in his speech just now, he can end this war immediately just by pulling his forces out of Ukraine. It's Putin that doesn't want to negotiate a withdrawal of Russian forces from Ukraine, giving Ukraine its territory back. So as long as we are faced with that kind of Russia, we can talk about negotiations all we want. It's simply not feasible.
Got it. The idea of giving F-16s to Turkey is something that has been floating around this week, and it looks like it is absolutely going to happen. Can we assume that in fact, was the transaction? I know the White House doesn't want to put it this way, but the transaction that unlocked Turkey to clear Sweden to join NATO?
I think it's several things. I think, first off, Erdogan arranging his re-election successfully. He was using the ability to stand up to Europe and stand up to Sweden, stand against terrorism as devices to make him look strong in a domestic context in Turkey. So that was part of it. Was just using it as an electoral device. Second, he did reach some agreements with Sweden on Sweden committing to do a better job of making sure that its territory is not exploited by the PKK, the terrorist group that operates in Turkey. And he got that from Sweden. And then also the F-16s, where the U.S., as you know, we've been holding back on fighter aircraft because of Turkey's acquisition of a Russian air defense system. But I think those are solvable problems, and I think it's in our interest to have F-16s with Turkey. So I think we did that, and I understand why the administration doesn't want to see it as a transaction. It probably just was one more thing added to the mix that helped it all come together, and it's in our own interest to do it anyway.
How do you view Turkey? You are the U.S. ambassador to NATO. How do you view Turkey as a player in this alliance? How do you define this relationship? Is it a trusted partner?
What I would say is that Turkey and the U.S. share the same strategic interests about 90% of the time. If you look at a map and you stand in Turkey and you look around, you've got the Black Sea, Ukraine, Crimea, Russia, Iran, Iraq, Kurdish region, Syria, Middle East. On most of these issues, the Turkish interest and the U.S. interest are very closely aligned. Now, they are not a subservient country. It's not like we're going to be able to tell them do this or do that. But if we work together with them, we'll find that they are a very powerful ally. They're a large country. They've got a capable military. They're in a critical part of the world. Now, we have a lot of differences with Turkey, particularly the way Erdogan runs the country domestically. He's got a very heavy hand, but we ought to be able to work with them on the strategic picture. And we haven't done a good job at that for years now. And I hope that what we've seen now with the F-16, with Turkey approving Sweden, with Turkey saying that they want to see Ukraine in NATO, maybe we'll start to turn a corner.
In a better place. How does that 90% compare to other nations? Is that, what's the metric here? How should our listeners understand that? Some perspective.
You can get to the very bottom of the list by jumping over to Iran.
Okay.
Or North
but I mean,
Korea,
within NATO, if we agree 90% of the time with Turkey.
I'd say it, in some cases, we're 100% aligned with our allies. I'd say that is largely the case with the UK, with Canada, the Netherlands. There are some cases where we do have some differences. Not that many. But even if we do have some differences with our allies, it's more important that we focus on the big picture and work together. And the one big thing, and when we're talking about NATO, it is about the security and defense of Europe. And there, I don't think there's any daylight between any of the NATO allies on the idea that an attack on one has to be seen as an attack on all. And we respond to that in order to ensure the security for everybody. I think that's the key thing about NATO, and I think everybody's committed to that.
How about Viktor Orban? How much do we agree with when it comes to Hungary?
Well, yeah, we have a lot of differences now with the way that he is running Hungary and his taking advantage of being in a safe and prosperous position as a NATO and EU member to do deals with Russia and do deals with China. So you have a lot of difficulty with that right now. But when it comes to defense of the NATO territory, Hungary is fully committed. And indeed, they've been taking part in air policing missions and stationing of forces in the Baltic states to demonstrate that they're part of NATO security.
Mr. Ambassador, great to have you today. We've been looking forward to the conversation all week. Kurt Volker, the former U.S. ambassador to NATO, who also served as U.S. Special Representative for Ukraine negotiations. We're bringing you insights from a true authority here. Following the speech from President Biden, he just wrapped in Vilnius and is now headed to Finland later today for a summit of Nordic nations. Let's assemble our panel for their take. Jeannie Shanzano and Rick Davis, the other two voices you need to hear from today. Bloomberg Politics contributors. Rick, you worked with Ambassador Volker for some time. I think you still might at the McCain Institute. With that said, do you agree with him in his take here? Did Joe Biden have a mic drop moment here or not?
Yeah, I think Joe Biden had a good week. We set up the week by saying we thought a big success would be Sweden coming in, and it did. I do think the fly in the ointment was the reaction initially by Zelensky that, he didn't get what he wanted. I mean, even if he didn't get what he wanted, why do you actually say that, right? I mean, like, you cheer the fact that you're embraced by NATO and that you're getting stronger every day and that you're going to take this fight with this group to Putin. You're really talking to Vladimir Putin at that point, right? And the last thing you want to do is undermine NATO. So even if he didn't get what he wanted, I mean, like, the fact that he's now spun on a dime and is thanking his NATO partners is what he should have said to begin with. I mean, like, we love him. He's doing incredible work and amazing sacrifice, but, like, this is how this game is played. So I think he's become a great leader, but he needs to have this international stage figured out a little bit better.
Yeah, the line from President Zelensky, I believe yesterday, Jeannie, was uncertainty equals weakness, and a very different tone today. Should he have sounded like this first, or is that a calculation on his part?
He should have sounded like this first. I think we can all understand his frustration. There is no question of what a great leader he has been for his country and how he is fighting as hard as he can to get them what they need. That said, I think the ambassador is 1,000% right when he says you don't bite the hand that feeds you. We are talking from the U.S. alone, $40 billion munitions. You'd never seen that lineup of NATO leaders that we saw on that stage and the full-throated support for Ukraine. People have said, and I think this is true, there is no country that is not in NATO that has done as well as Ukraine has. So he does have to be very careful about that. He seems to have understood that in his more recent remarks, and I think that is critically important. I also think there's something else not being said here, which is the fact that we are all talking, and we hear it all the time in D.C. and elsewhere. There's going to have to be a diplomatic resolution to this thing. Russia is not going to sign off on that if Ukraine is going to be in NATO. And so the U.S. and NATO allies are reluctant to say that at this point. And Zelensky, on the other hand, is saying if we don't get in now, we're never going to get in. So that is something they want to keep open for negotiation from NATO's part. But for Zelensky, of course, that may be a sign that this is never going to happen if we have to negotiate our way out of this. And so there is a big sticking point, and it's going to have to be negotiated out, and it's not something that he is going to welcome. He's worried about the outcome, and right he should be.
Did you agree with Ambassador Volker, Rick, that we actually might have encouraged Vladimir Putin here? Or are there shades of membership? Could NATO do more to formally pledge military aid to Ukraine? Or have we already done what can be done in this case?
No, I absolutely agree with Ambassador Volker. I think that we missed an opportunity to just lock down Ukraine as a free country. I mean, slightly critical of President Zelensky for sort of spitting the bit on the news, but the reality is he was just reacting to what I think universally people see as a weak stand by NATO and a weak response by Biden. I mean, this could have been much more than it turned out to be. Even if there are hesitations, as Ambassador Volker said, even if there are conditions that need to be met and allies who aren't in total agreement, you don't say that. You find a very strong message, because in this case alone, you're sending a message to Vladimir Putin and no one else. NATO's already in agreement what's going to happen here. Ukraine is already in agreement what's going to happen here ultimately. The only guy who you are talking to at this point is Vladimir Putin, and the notion that somehow we'll figure it out later is exactly what Vladimir Putin wanted to hear. He'll just keep fighting until there is no more Ukraine, if this is the case.
No more Russian military.
That's right. Well, look, there are more Russian military units that can be put on the field than Ukrainian. And the idea that we're having World War I tactics in the 21st century actually plays to Putin's strength. I mean, until we actually change that, it's still advantage Putin on this thing. So, I think it's a missed opportunity, but that's just half the speech today. I mean, Biden was really talking a lot to the American voter today in this speech. Who would have thought he'd gone to NATO and talk about climate change, talk about supply chain issues? I mean, there was a completely sort of 1-2 punch here where it's one, I'm going to cover the NATO front in Ukraine, and then on the other front, I'm going to, talk to people about what we need to do about my reelection.
Well, let's get into that for a minute, because I think we've already established here on this program that this is the one thing, this is the most envious thing, the most envious position that the president could put other presidential contenders in here, watching him work the world stage like this, Jeannie. Listen to the the victory lap, as we put it on the terminal just a short time ago.
I had the great honor as United States Senator of championing Lithuania and other Baltic states to join NATO in 2004. Wasn't I brilliant doing that?
Wasn't I brilliant doing that, Jeannie? This is a president who is feeling emboldened. What do the other candidates think watching this?
You know, and right, he should. This was, I think, a real success trip for Joe Biden. He is in sharp contrast to the #1 candidate on the other side, Donald Trump, who wanted to withdraw from NATO not that long ago. You hear people around the world concerned as to the outcome of the 24 election, particularly as it concerns our funding for Ukraine. I couldn't agree more with Rick that he was speaking to an American audience several times during this trip, not just talking about supply chains, but also as he confronts a real threat from Republicans attempting to defund support for Ukraine. We saw Marjorie Taylor Greene and others introducing these amendments, these resolutions. We've heard McCarthy say he's going to stand strong against that, except he wants to go through regular order. So this is a very real challenge for Americans in the domestic front. And Joe Biden, we shouldn't forget, in the 2020 campaign, he said this is a choice between democracy and autocracy. He feels like the war in Ukraine has underscored what he saw coming out of this, and he is going to keep sticking with that as he goes into 2020. But he's got to, of course, keep American support amongst progressives on the left and conservatives on the right in terms of funding out of Congress. And that is going to be a challenge because Americans feel maybe $40 billion is enough in many cases.
Jeannie mentions Marjorie Taylor Greene, who offered an amendment to the NDAA, the National Defense Authorization Act, that was aimed squarely at NATO and this summit. Here she is.
Amendment number 6 directs the president to withdraw the U.S. from NATO. My amendment would direct the president withdrawal from NATO. They are not a reliable partner whose defense spending should be paid for by American citizens.
The gentlewoman from Georgia says it's time to withdraw from NATO, Rick. I know you don't see Marjorie Taylor Greene. I don't think anyone sees her as speaking for the Republican Party. But I was going to ask you if Donald Trump or Ron DeSantis might show up in Europe or somewhere on the international stage to sort of match Joe Biden here. But maybe that's the exact opposite of what a Republican candidate wants to do right now.
Yeah, I don't think it's an exact opposite. I think that this has historically been a space that Republicans have occupied, the support for NATO and engagement around the world. And I think Marjorie Taylor Greene just showed that she is actually not a relevant or serious person with this kind of showboating. And I would think the real person who's on the spot here is the speaker, who calls Marjorie Taylor Greene his advisor. And, you know, I think it's time for him to walk out and say, I totally disagree with Marjorie Taylor Greene, because this is not even close to Republican doctrine when it comes to support for NATO and the strength of our country in NATO.
Of course, we remember the whole conversation that Donald Trump had about nations paying their fair share. He even threatened himself to withdraw from NATO, and it'll be interesting to see how that's reflected on the campaign trail going forward. We'll keep our eyes, I guess, on social media for more on that. Jeannie Shanzano and Rick Davis, Bloomberg Politics contributors, our signature panel on an historic day as NATO concludes this two-day summit. The president heading now for Finland, as we mentioned. It's been a big day here inside the nation's capital as well, and not a very fun one for the head of the FBI, grilled on Capitol Hill. We'll talk more about that ahead with Rick and Jeannie. After we get an update on the news, world and national headlines from the Bloomberg Newsroom in New York, here's Dan Schwartzman.
Hi, Joe. President Biden wrapping up his 2 days at the 74th NATO Summit in Vilnius, Lithuania, with a keynote speech at Vilnius University. Biden speaking about the increased strength of the NATO alliance and the cooperation amongst the bloc to continue to arm and support Ukraine. Biden also meeting with Volodymyr Zelensky to ease the Ukrainian president's concerns regarding a time frame for his country to officially join NATO, saying it's just a matter of time.
I hope we finally have put to bed the notion about whether or not Ukraine is welcome in NATO. It's going to happen. You're all moving in the right direction. I think it's just a matter of getting by the next few months here.
As you said, Joe, the president next heading to Helsinki to celebrate Finland joining the bloc. U.S. Special Presidential Envoy for Climate John Kerry will be heading to China next week. Kerry's going to discuss strategies to curb global warming with his counterpart, Xi Jinping, as relations are seemingly warming between Washington and Beijing. Kerry will be the third high-level American to head to Beijing recently, following Secretary of State Antony Blinken and Treasury Secretary Janet Yellen. Amtrak's facing some of the steepest cuts it's ever seen under a new House transportation appropriation. Here's Amy Morris of Bloomberg.
Amtrak would receive $876 million under the bill, a 64% cut. That slashes more than $1.5 billion from 2023 funding levels. The Transportation Department budget also cut by more than $7 billion. And the bill blocks funds for a high-speed rail corridor in California. Amtrak CEO Stephen Gardner released a statement saying the cuts would force the rail service to reduce or suspend service across the country and would negatively impact jobs in the economy. In Washington, I'm Amy Morris, Bloomberg Radio.
Thanks, Amy. Global news 24 hours a day, powered by more than 2,700 journalists and analysts. I'm Dan Schwartzman, and this is Bloomberg.
This country on the Canadian housing market. Canadians have taken on huge amounts of debt. We have a different mortgage market than in the U.S. So a lot of Canadians have already felt the impact very quickly of these higher mortgage costs. Ironically, it's actually part of the inflation story at this point in Canada. At what point do you start to get concerned about the housing market within this story of the economy?
Well, the thing about the housing market here in Canada, as you said, our mortgage market is structured differently. And we do know that about a third of Canadians have a mortgage and the rest do not. So yes, they're renting, so that's all filtering in through the economy. But in Canada, we have a very supply-constrained market, and we have lots of immigration. So lots of persistent demand for homes. Now, not necessarily to buy, but to rent as well. Again, all of these factors, persistent demand but not enough supply, really, I think, going to keep the housing market on level ground, maybe not accelerating sharply, but not necessarily headed for a U.S.-style crash.
And Kevin, let me bring you into the conversation on the mortgage picture stateside as well. Matt was talking about Torsten Slok, who had talked about the fact that if you locked in a 30-year mortgage over the last couple of years, maybe you have felt less impacted today by the interest rate realities. What are you seeing on that part of the equation right now?
Yeah, we've had a little bit better news on the inflation data after really several months of weakening all through last year. So we found a little bit of stability in more recent months. I don't know if the worst of it is probably behind us, and we may have a more, less of a drag from housing. But the direct impact on the U.S. economy isn't likely to come from residential investment. It's likely to come from consumption slowing. And we've seen a little bit more wavering this year. And if we're right and the labor market is slowing and we start to see the unemployment rate go higher, we're more likely to see perhaps some more pullback in residential investment. But the share of housing in the U.S. probably isn't going to be all that big of a drag, or even if we're wrong and it does start to pick up a little bit, given that supply is still so tight in the housing activity, that it's not going to offset any sort of downside risk to the economy, I don't think.
Don, what do you think of the effects? If the Fed is near finished and other central banks continue to need to hike more, what do you think about the FX effects that we're going to see? Is the dollar going to continue to weaken like we're seeing today?
Well, I mean, if the Fed actually goes through with their next one, I don't think from the Canadian perspective we're going to see a lot more. As I've said, I think we're probably likely going to see the rate hold at this level. So I think from the currency's perspective, you know, a lot in Canada depends, from our currency's perspective, on oil prices, and they have come up, and that's been an underpinning factor today. Going forward, you know, if they level out and we don't see the Bank of Canada move any further, it's probably not going to be a huge increase in Canada's currency as we go forward.
I was thinking more of the euro, the pound, the yen, those currencies that seem to be gaining a lot more strength over the last few days. Is that going to pick up? Kevin, what's your view on the FX?
Yeah, I'm going to stay in my lane. I'm an economist, not an FX strategist, so I'll hold off from making any sort of comments on that.
Wise choice. John, what do you think?
I'm neither an economist nor an FX strategist, Matt, but I do like to ask questions for a living. So, Don, let me give the last one to you. What is the most important thing to watch at this point to try to determine where both the U.S. and Canadian economies go from here?
I think it's confidence. You know, we've seen a deterioration in confidence here in Canada, both on the business side, but in particular on the consumer side. If Canadian get on shaky ground, Canadian consumers, I think that will be a very key factor for the bank.
All right, Don, really a pleasure having you with us. Deloitte Canada Chief Economist Don Desjardins and Kevin Cummins joining us from NatWest, Chief U.S. Economist there. Thanks so much for joining us. Hope we get to talk more soon. Coming up, Lucid tanking after EV deliveries for the second quarter disappoint. That's our stock of the hour. Next, this is Bloomberg.